Good morning, ladies and gentlemen. Thank you very much for attending our annual seminar today. As you might expect, it will be a busy day, but you know us. In a couple of minutes, Henri de Castres, Chief Executive Officer, will make a short introduction. Henri and Denis Duverne, Chief Financial Officer, will conclude the day with a Q&A session. During the day, it will be your extreme privilege to attend 5 workshops covering UK, US, Japanese, and European P&C operations and our risk and capital management. These presentations will be held by members of the management team. They will last 45 minutes each, 25 minutes presentation, 20 minutes Q&A. You will have a 1-hour break for lunch from 1 to 2, which is good news, but only if you help us remain on schedule. Thank you very much. Henri, the floor is yours.
Good morning, ladies and gentlemen. As you've seen, Etienne is in a very military mood this morning. He told me, you have to be brief. So I'll be brief. Welcome for this 5th conference. As he just told you, the program is a quite busy one. So I don't think I'm going to spend a lot of time for the introduction, but I just wanted to share with you some very general and preliminary thoughts on top of the sessions you are going to attend during the day, and knowing that the lunchtime will be used to answer your questions. We are in November, and I think the world is looking slightly different from what it was looking a year ago at the very same time. You seem to be in a sort of better mood. So do we, because we think that even if the storm has been a very, very severe one, as usual, big turbulences are disasters for some players and opportunities in creation for other ones. And we think that the very significant turmoil the world economy has been going through is going at the end of the day to prove as an opportunity for us. Why so? Well, you'll discuss some of the elements during the day, but I think there are 3 key lessons to be learned for us. The first one is that if anything, this storm has confirmed the validity of the business model we have chosen years ago. You all remember that we've been faced regularly with questions on the business model because some other players were picking different routes. We think that the crisis has confirmed the validity of the choices we have made, even if in some areas we have suffered, but who has not suffered in this crisis? The second point, which I think is important, is the reaffirmation of the financial strengths of the group. We know that some of you have had doubts. Was not something new for us, since in the previous crisis we had something which was similar. People were expressing doubts about the financial strength of AXA just because we had been one of the fastest growing companies in the sector and just because we had always been managing our capital tightly. I think this crisis has demonstrated that if you have the right risk management systems, you can emerge safe out of very, very significant turbulences. The third point, which is important, it's an opportunity for us, reinforcing customer trust. We are in a situation where many other players are, I would say, facing issues which are mobilizing most of their management time, which are not customer-facing issues. We can spend a lot of time trying to improve what we do, trying to improve the trust of the customers, and therefore long-term gaining ground in our businesses. These are the 3 points I'm going to briefly highlight. The first one, the business model. The fact that we have focused on insurance and asset management businesses, what we used to call financial protection, has proven to be quite effective. The fact that we were not a bancassurance player in the sense where we were not owning a large universal bank balance sheet, I think doesn't need to be explained in detail. The last examples of these models have, let's say, suffered or disappeared. We have avoided that. The second point, which is important because it has always been one of our fundamental choices, being in these businesses and playing the game of geographical and business line diversification, it has worked, as you have seen. Because yes, we have been affected in some of the activities, geographically and by business line, but the diversification has helped to resist. The third point, which is important, is the existence of global business platforms. It has been an advantage in this crisis. It's a point where we are going to accelerate because we think it's an opportunity for us to reach the next step. Once more, at a time where other people are going to fix their balance sheet, we have the opportunity from an industrial standpoint to move to the next level. So what do we want to do next in terms of business model? Very simple. Expand distribution further. Bancassurance agreements without owning the banks. We think that you will see very significant changes in the banking system and that because of their capital issues, the banks will be forced to revisit the issue of their capital allocation, especially to insurance activities. And we think this is going to give us an opportunity since the name is reinforced by the fact that we emerge safe out of the turmoil, and since we have, I would say, large opportunities in terms of product offering or bancassurance distribution models. Second point, we want to continue to grow the traditional sales force because this sales force has proven to be resilient in the crisis. Last point on distribution, we want to accelerate the efforts on the direct side. We are now one of the largest, if not the largest, direct worldwide player with various experiences in different countries. We think we can accelerate that. The second key point is increasing the footprint in emerging markets. We will have growth there. It can be in many places profitable growth, not everywhere, but in most of the places. We want to reinforce our exposure. It's not that we had not started. If you look at the evolution between 2004 and 2009, the share of emerging markets in the businesses of the group has been steadily increasing. But it's one of the things on which we want to change gear and do new things. I would say the operation which is going on in Australia is one of these illustrations. Recapturing the interest of the minorities there is an obvious move, which we hope to be in a position to complete one day or the other. So that's where we are as far as expanding in emerging markets. Last but not least, additional transversal initiatives. We are going in the coming weeks to slightly modify the organization of the group. We think we are at a point where both on the P&C and on the life side, we can, I would say, change the organization and foster more convergence. So we will put in place a new organization, both in terms of P&C and on the life side, to accelerate the convergence efforts we've been doing over the last years. So expect that more is going to come there. Second point, financial strength. You've had questions. Some of you even had very serious questions on that. We think one of the strengths of the group is the ability to manage the capital efficiently and tightly. It's exactly like in the airline industry. If you have the appropriate measurement tools, you can fly safely at altitudes which are different from your competitors, and it's not because you add capital if you don't have the right measurement tools that you fly safely. So I think we have proven that with the right risk measurement systems, you can fly safely in very turbulent skies. The Solvency I ratio has proven to be resilient. The rating has been reaffirmed in the AA range, and there are few players there now. I think the quality of the internal economic capital model is now demonstrated, even if it's something where there is a permanent improvement which has to take place, and we have lessons to learn from the crisis. I'm not telling you that we would do everything the same way as we have done it if the same thing would occur again. We know what are our weaknesses, and we think we are well on track for correcting them. Last but not least, I think if you look at what we have done in some of the areas where we had issues, the reactiveness of the group is not limited to its M&A operations. It's also true within the operational models. And one of the reasons for which we have emerged safer than others is the proactive product repricing we've been in a position to do in various places. Because we know, I think, better from a group standpoint, where are the risks. It enables us to react faster than some others. What's next then? First, we have to optimize better the balance between insurance and financial risks. And one of the workshops is going to handle that. Second point, we are well prepared, but we want to increase that further to Solvency II. In fact, one of the reasons, I think, for which we have been doing the relatively well when compared to most others is the fact that for years we had been investing significantly in understanding the consequences of Solvency II and starting to manage already against Solvency II, which is a better risk measurement system than Solvency I, clearly. Last but not least, and it's something Kip is going to cover in the session he will make, we are well positioned to launch the next generation of products. And it's one of the lessons we've learned with the crisis. Some of the products have shown to have, I would say, consequences which were not the consequences we were expecting. So we had some corrections to make. But going forward, if you understand the customer needs, some changes have to be made to face their expectations. And I think we are ready for that. Next point. Customer trust, it's not a soft area. It's the core of creating future market shares or increasing the market share further in the places where we already are. And I think that there we are pretty well positioned. The brand is now a leading brand according to industry surveys. Some of you have probably read the last UBS study on insurance brands. It's interesting. The same way, if you look at the Interbrand study, which is something which is published every year, you will see that AXA is now very strongly positioned as a key insurance brand. We think it's good. It's not enough, but we think it's a very solid positioning. Second point, increasing customer satisfaction. This was one of the areas where we think we had a lot, or where we thought we had a lot of things to do. For the very, I would say, for the consequences you all know. I mean, you can attract a lot of customers. If the service is poor, you lose them, and the machine is unduly expensive. We've been doing progresses there. You will see that. This is going to lead to improving client retention and improving the cash flows. The cash flows have proven to be very resilient in this crisis. We want this to go forward and to improve further. And we think that through the quality of service, there are still significant opportunities there. So we are going to continue what we had started as part of the Ambition 2012 plan to continue to improve customer satisfaction and lead to a better quality business with better margins. It's not because the numbers we had in mind for Ambition 2012 cannot be reached because the evolution of the markets has not been what we were expecting, that the industrial and initiatives are slowed down. We think that the vision we had at the time, which was to increase customer satisfaction, increase employee engagement, both of them together, creating profitable business opportunities, this is still valid. And I think it's a key competitive advantage for the group, because once more, there are many players out there who these days cannot have the luxury of concentrating on their operational business. So we will remain focused on improving our operational efficiency. And these are the points where the management is spending most of its time. So it's spending the time to improve the operations as opposed to spending our time fixing holes or whatever. What are we going to discuss today in some of the workshops? The UK operations, because they've been a question for you, given their below average profitability. And you will see that as of today, we have the feeling that the position has been reinforced in various business segments, where AXA UK has been repositioned by Nicolas and by his teams. He will also explain you what are the opportunities in terms of enlarged offer, cost reduction, and in diplomatic terms, capital optimization. How can we do the same business with less capital? And are there opportunities there? Second point, the Japanese operations. Some of you have been questioning the strategic validity of our presence in Japan and have been questioning the profitability and the long-term growth. We maintain the fact that this is a highly profitable protection business. This business is going to distribute dividends to the group for the first time since '99. And we think that we now have the opportunity to grow in a landscape which is less competitive than what it used to be 2 or 3 years ago, because some of the players, notably among the foreigners, have vanished or are significantly weakened. The third point is the European P&C operations. P&C has proven to be very resilient in the crisis, but P&C, because of the recession, has been under pressure. François is going to explain you how we are going to maintain a combined ratio well below 100% through the cycle, and how we are going to be able to leverage the upside potential we have in most of these markets for Europe, and also how we are going to leverage our strengths in emerging markets and in say expanding distribution channels like the direct business. Last but not least, Kip is going to discuss with you the US operations. We've been affected in the US operations last year by the volatility. I mean, you all know that, and by the consequences on variable annuities. Our sales today are low because we have repriced the products at risk levels, which were the risk levels or are the risks levels we think are acceptable. Kip will explain you how it's going to move forward and why we think that with the new range of product we have a quite convincing offer to the customers. So these are some of the elements which you are going to discuss today, and of course we will take all your questions over lunch. Having said that, I think that now you are going to be split between the different rooms, and I hope that I have not taken more than the time which was allocated to me by Etienne. Thank you very much.
Thank you, Henri. You can now go to the rooms B and C, which are behind me. So you go out of this room, please. And the workshops are going to start.
D'accord. Ah oui. Of this meeting, not to introduce Etienne because you know him. Mathieu has been with AXA for quite a long time. He's both a certified accountant in France and a CPA in the US. His last position was in AXA UK in charge of financial and risk reporting, and before that he was working in the group consolidation team in Paris, so he has a very deep experience. I will not tell you all about him, but Mathieu will succeed Etienne after the earnings next year, and is now in getting to grips with his new job. So I'll welcome him, and it's too early to thank Etienne for his achievements because Etienne is still firmly in the job. With that, I'm not sure that I have something to move the slides though. Thank you. So I'm going to talk to you about risk and capital management. First, obviously, it looks like a little bit of calm after the storm. We don't feel that we are completely in a good territory, but stock markets have partially recovered. Volatility, even though it is still relatively high, is much closer to its long-term average. Spreads are stabilizing above their historical average, and that we are clearly very far from the peaks of the end of last year and the beginning of this year. And interest rates have picked up from the year-end 08, but are still relatively low, indicating that there is still not significant anticipation of higher interest rates, nor anticipation of a deflation. So it's a better territory for a company like AXA. I'd like to cover essentially 4 items today. What went well in the crisis? What lessons did we learn? What do we do to keep our market risk under control? And what are the new performance indicators that we are using from a risk management standpoint? During the crisis, we definitely enjoyed significant diversification benefits. It's not just talk, it's reality. As you know, from a revenue standpoint, we are 2/3 life and savings and 1/3 P&C and a little bit of asset management. But from an earnings standpoint, P&C increased in earnings by 31% in 08, while life decreased by 43%. Asset management, because of exceptional, was up 6%, and we will see the, I would say with the lag, the decline in asset management earnings this year. Clearly, the business mix has helped us during the crisis. From a geographic standpoint, You know that we have a well-balanced geographic footprint with very diverse footprints in Europe, but also presence in North America, Asia, and emerging markets in 3 regions: Asia, Central and Eastern Europe, and Latin America. When you look at the earnings, all regions experience positive growth in 2008 on an underlying basis, except the US, which experienced a significant loss, and that loss was significantly offset by the gain in the other regions. These diversification benefits are also apparent in our distribution and client mix. From a distribution standpoint, we have always insisted on the importance of proprietary distribution, which is roughly 40% of our distribution in life and 50% in P&C. When we look at what happened during the crisis, our agents had a stable business, even on the life side, while we saw a more significant decline with partnerships and JVs. So proprietary distribution is a very important feature for AXA because it dampens the impact of any crisis. In a period of growth, third-party distribution would grow faster, so we need that as well. But in periods of turmoil, proprietary distribution represents the more stable element of our footprint. From a client perspective as well, we have a very strong in our mix. We have a very strong presence of individual clients, which represents 88% of our life business and 57% of our P&C business. Our P&C business is essentially individual and SME. We only have 7% of our business, which is large commercial risk. And this mix in terms of clients has also been extremely favorable in the financial crisis. We've continued to have strong positive cash flows in the life and savings business with plus 7 billion euros. And we gained 1 million clients, 1 million individual clients in P&C, and also a number of clients in SME during that period. Our risk management actions were effective. We implemented on the asset side an equity hedge in the spring of 2008, which translated into 1.6 billion euro gain. We had no credit default above 300 million euros, which is a testimony to our diversification and the limits that we put on concentration of assets. We had a systematic characterization of derivatives, which meant that on the Lehman case, we only suffered a loss for the decline of assets on the Monday following the default. From a liability standpoint, we had no liquidity issues. We didn't have any credit enhancement activity, so that meant that we had no issue on that side. From an ALM standpoint, we have a very rigorous policy in terms of duration gap. We limit it to less than 1 year. And clearly, this is going to be more and more important with Solvency II. A gap of 2 years in Solvency II would mean 14 points for us of decline in our coverage ratio. And it means already 10 points in rating agency models. From a solvency and rating standpoint, as Henri said earlier, we remain in the AA range, while the average rating of the sector was down 1 notch. Our Solvency II ratio is around 155%, and our Solvency I ratio, excluding unrealized capital gains on bonds, is above 140%. This being said, we did suffer substantially from the crisis, and we learned a lot through that crisis. First, the unthinkable can happen, and we have decided to put more weight in our decision-making process on stress test scenarios. We have an internal framework which is based on our internal capital model, which is using stochastic calculation and is well embedded in the business. We look at 4 metrics to make our business decisions: value, earnings, capital, and liquidity. And we look at the metrics that bites the most to take corrective actions. Still, we have changed a number of things since the beginning of the crisis. Our calculation frequency has moved to a quarterly calculation, and we have, in our tail risk scenarios, changed the calibration of corporate spreads, which were clearly at the end of 2008 and beginning of 2009 higher than what we had in our 1 in 200 year scenario. And similarly, we have adjusted correlations, which have proved to be slightly higher than what we had thought. We are every quarter doing these calculations using what we call the adverse scenario, which is a 1 in 20 calibrated at 1 in 20 year as a 1 in 20 year event. We're using extreme events calibrated at the 1 in 200 year, which is the 99.5% confidence interval of Solvency II. And we are also using combined scenarios like severe deflation, deep recession, and so on. When we look at our short-term economic capital model, and we see that because of our important footprint in life and savings, and the size, which means that we have a big balance sheet, market risk represents 61% of our capital requirement. And life risk represents 21%, P&C 24%, operational risk 13%, counterparty risk 9%. So if you consider that counterparty risk is also a financial risk, we have close to 70% of our risk which are financial. Diversification benefits brings that back to 100%. So financial risk represents, market risk represents 61% of our capital requirement. And you may think that this is too much, and this is something that we are currently looking at, how to maintain this at a reasonable level. The second question, obviously, is how does this measure of internal short-term economic capital impact our key performance indicator, and I will come back to that later. The third aspect of this presentation is how we keep market risk under control. I talked to you about this quarterly review that we do of our balance sheet. For each asset class, we are both at the group level and at the local level, we have this red, amber, green picture where we look at our asset allocation along those 4 dimensions of capital, value, liquidity, and earnings. Right now, we are in a position where, as you know, we have a balance sheet where 79% is fixed income, 4% is listed equities, 5% real estate, and 2% alternative investments. We are broadly between the green zone and the orange zones, which means that we have little flexibility to increase our risk exposures. And we monitor that on a very regular basis. Solvency II forces us to look at the risk-return profile of each asset class in a slightly different way, not taking just into account ALM constraints as we were doing in the pre-Solvency II world. In the pre-Solvency II world, we could allocate 10% of our assets, or even slightly more, to equities. Before the financial crisis, that's what we had. In a post-Solvency II world, it's really not something that is manageable, because the capital requirements that you see at the bottom part of the slides are extremely onerous for asset classes like equity, private equity, or hedge funds. And when you combine the 2 graphs of the previous slides and you look at slide 14, you see that the risk-return profile of the different asset class is such that investment-grade corporate bonds are the asset class that has the better risk-return profile. Therefore, managing corporate bond risk has become increasingly key for us. From an underwriting standpoint, as you know, we delegate, our insurance companies delegate the management of the assets to our asset managers. But we have decided to strengthen this process by performing a credit analysis both in the asset management company and in the insurance company, with a second opinion from risk management. For the most important decision, the group CIO, which is a position that we have created with effect from the 1st of January 2010, will have its say on the main decisions. From a risk management standpoint, we look at our concentrations along many dimensions, by issuer, by sector, by country. And we have also taken a measure which is to put a limit on the credit risk duration. So we have an overall limit on duration, we have concentration risk limits, but we also have a credit risk duration limit to 4 to 5 years. The second area where we have done a lot of work post-financial crisis is variable annuities. This is a topic that you know well, and which Kip Condren will develop just after lunch. You know that we have addressed our volatility issues in a significant way. When you look across the areas in 3 regions, Japan, US, and Germany. In Japan, there was very little success of AXA in VAs because we had decided to fight only in the GMIB territory, which was less than 10% of the market. Most of the market was competing on GMAB, and we didn't know how to hedge GMABs at the prices that were prevailing at the time in Japan. In 2009, we've seen, as a fallout of the crisis, that most of the leading players have exited the market. And we now have a GMIB, which we also have repriced because of movements in interest rates, which is competitive and profitable for us, and we are gaining market share. In the US, as you know, we went through 4 subsequent repricing actions in November, February, June, and we are going through a new product design in November of this year. We both repriced and changed the product design of our products. We are, as Henri said earlier, probably at the more conservative end of the spectrum compared to our competitors, which means that short term we have lost market share, but we believe it's important to be in the market with a product that is profitable and in line with our risk profile, rather than to compete on price in the current market environment. In Germany, we suffered a loss in 2008, as we did in the US. This loss was related to the drop of interest rates. We have relooked at our product portfolio and decided to stop one of the variations of a product called Twin Star Invest. We have completed the hedging of interest rates through of long-term interest rates through a swaption program, and we will launch in early 2010 a new variation of this Twin Star Invest product. We believe that VAs have a future in the group, that the VAs that we sell now are fully in line with our risk appetite. This was a painful experience. We've learned a lot, but compared to a number of players, we were conservative all through that period. We had no products that we were not hedging, and therefore we can come out of that situation stronger. we have, in this VA action plan, we have expanded the use of allocation funds. Allocation funds were already a significant part of our US offering. We are offering two variations in the US, allocation funds and guided architecture. We believe that for the customers, this is better because usually customers make the wrong choices in terms of asset allocation at the wrong time. We believe that this will be good for the investment performance and good for the both the basis risk and volatility strategy that we have. For us, it means diversification of assets. We are able to apply our volatility tool, which I will comment in a second, to mitigate equity volatility, and this gives us a permanent flexibility in hiring and firing asset managers in our architecture. This is something that we have developed in the US and we are rolling out in the rest of the world using the Architas platform that was developed in the UK. On equity volatility, we have introduced in the US what we call the ATM, the AXA Tactical Manager Strategy, which is such that when volatility is high, we switch the customer out of equities. When volatility is low, we bring the customer back into the equity markets. This switch happens in the area of 30% volatility. We've backtested that strategy, and if we look at the 2007 to 2009, first 9 month periods, we have been able to show that this volatility tool translated into an increased asset performance, because when volatility is at extreme levels, usually the asset performance is rather poor. Last topic of this presentation, we are moving to new performance indicators, because we believe that we need to, I would say, embed the new risk management framework that we have developed over the years more firmly into our business units. The first one is return on short-term economic capital, which we, I would say, cascade into two indicators, the net income divided by short-term economic capital, and the second one, which we see at the bottom, which is the variation of the available financial resources divided by the short-term economic capital, which is a measure of value creation. We are cascading those indicators to our various business lines to make the appropriate business decisions, splitting the life and savings market between the different subcomponents, and splitting the P&C markets in the same way. We believe that it's an important element going forward, because it will, I would say, create ownership of those indicators in the business lines, and people will understand that if their business is using too much capital for a defined return, they will not be able to keep that business in the same way, and they need to change it. And the other series of indicators, the other indicator that we have developed is on the P&C side, where because combined ratio is a tool that is very simple, but a pure combined ratio will not tell you the appropriate answer in terms of hurdle rate for profitability, depending on the business line. If you have a short tail line, you will need a lower combined ratio to make to make an acceptable return. If you have a long tail line, depending on its volatility, you may afford a slightly higher combined ratio. So this economic combined ratio is developed by risk management, our management teams, in a way which is such that 100% is the hurdle rate. So we translate all the, I would say, traditional combined ratio into an economic combined ratio. If you are above 100%, that's bad. If you are below 100%, that's good. That's a simple message. But we we incorporate into the combined ratio the cost of risk, the business duration, and a normalized cost for natural catastrophes to make combined ratios comparable across business lines, across the years, and across geographies. When we look back at 2008, we see that we have a necessity to decrease our economic combined ratio, which for the group averages for the current year 101.5, which means that even though we had an accounting combined ratio at the end of 2008, which was below 100%, I would say the accident year 2008 was overall not a good year for the group. It was a good year still for motor, liability, and health, but already a bad year for property. On a country-by-country basis, it was still a good year for France, Switzerland, and the Med region. It was already a bad year for UK, Germany, and Belgium. I'm saying already because the reality is that 2009, on a current year basis, is, as you've heard Henri say earlier, is slightly worse than 2008. And when you move to one of the next workshops with François Pierson, you will hear what action plans the group has put together to get back to below 100% of economic combined ratio. This, I mean, in a snapshot, it's a series of repricing actions, but also moderating new business activity in soft countries, and also actions on the claim side. Finally, to conclude this introduction to the Q&A, life and savings business has gone in 2008 through a very tough crisis, which was comparable or probably worse than what we had in P&C in 2000 to 2002. Risk management has allowed us, as in the previous crisis, to navigate reasonably well through the storm. Going forward, the combination of normalized Solvency II rules across the sector in Europe, upgraded risk management in life and savings, and key performance indicators that are cascaded to the business lines using the same metrics should lead to a lower equity risk premium for the insurance sector and for AXA. With that positive note, I'd like to thank you and open the floor for questions.
Okay, well, good morning. It's good to see first that part of my presentation is already on Bloomberg, which means that it could have some interest. So today that's an opportunity for me to give you an update on where we are on the UK strategy. Some of you might remember that in 2007 we already went through an extensive presentation. As you will see, the strategy is still very consistent. Of course, last year's events have obliged us to make some adjustment or to accelerate some of the decision. So you will see a greater focus on expense management and on capital management, and also an acceleration of the transition from the old world to the new world, and decommissioning of some of our old business. So we'll focus this morning first on the UK environment, our position in the market, and also I will demonstrate to you our delivery on this strategic plan since 2007. And we will be focusing more on critical action taken and on key achievements rather than having a systematic review of our business. In the last 18 months, we've been through many shocks in the UK market. It is not specific to the UK, but the crisis in Great Britain have been very severe. We've seen a huge contraction in the GDP, a big increase in unemployment, and all that coupled with a very soft P&C underwriting cycle and underwriting market. And I would say that the market is remaining very challenging, especially given the weather event we have had in the past weekend. So of course, our financials have been impacted, and the 2012 targets that we set in 2007 are therefore no longer realistic. Also, we believe that they are still valid. Now the delivery is quite unclear. If I give you quickly a trading update about what has been going on in the past years, just to reposition where we are. On the life side, 2009 has been an interesting one. We've seen a shift in our mix of products on wealth management and corporate pension to our big business line. We've seen a decline in the new business that have been lower than the market, so we've won market share, but still we've been impacted by the market. In the same time, our protection business have grown quite a lot, especially our direct protection business. And I would say we've taken a lot of action on expenses that you will see later, meaning that our NBV margin will remain around 10%. So it will be a bit short of 10%. I hope that we'll be able to reach a trigger of 10%. On the non-life side, again, conflicting messages. Our PPP business have been growing a lot in the past 3 years, especially the international part of PPP. On AXA Insurance side, with a change in the management of the company, we've entered into a cleaning of the portfolio. So we are seeing a declining portfolio on the commercial lines and the corporate partner side, with a growing direct business, but we'll come back to that later. Most of you know well the UK market. It's a very large market, the third market in the world, but also a very specific market. There's no clear leadership in this market on an overall basis, but it's quite a specialized market, so you can see a lot of leadership in various parts of the market. So you will have clear leadership in the ability market, in the health market, or in the protection market, but you won't see an overall leadership. I think this is quite important in terms of strategy and in terms of positioning. If you want to be successful in this market, you need to have a specialized approach to the market and a specialized proposition in this market. Now we feel that there's huge opportunities in this market. On the life side, there's a pension and savings gap that is absolutely huge, with the defined benefit market that is closing to new members, and the development of the DC market or the single pension market. There's also a very large protection gap. A lot of people are undercovered, and we see that through the growth of the protection market. On the P&C side, this is a market which is very specific also in Europe, because cycles are very large. But over the period, when you look across cycles, this is a profitable market. Even if with the entry of aggregators, we see it as getting more and more competitive. In 2008, aggregators were representing 44% of the new business in motor insurance. I believe that in 2009, this figure is more around 60%. But for a newcomer like us in the direct internet business, I feel that this is an opportunity. The strategy that we described to you a few years ago has not really changed. I don't believe the drivers of the market has changed either. I just want to focus on one aspect which will reshape the market in the coming years on the life side, which is the RDR, Retail Distribution Review. This is a critical regulatory reform in the UK market, as in fact the IFAs will not be allowed anymore in 2012 to get commission from product providers. They will only be allowed to take a fee from their customers. That's one important aspect of this reform. The second one, which is not to be neglected, which is the fact that the training and the professional training of the IFAs, the standard is being increased a lot, and a lot of IFAs will get out of the market because they will not bother going through the exams to be qualified. This should have a very large impact on the market, as we think that the IFA sector will shrink by at least 30%. Now, if we go one by one through our strategic agenda, the first one is more cultural, as we believe that if we want to focus on the most profitable niches in the market, we need to have a specialized approach to these markets. That's why in 2007 we reorganized our organization by specialized SBU. Each of these SBUs, both in life and non-life, have a specialized offer to their market, a specialized distribution strategy, and a specialized focus. And we believe that going through this specialized approach in the market, not only we are more adapted to the market needs or to the market distribution strategy, but also we are creating better accountability, better engagement of the staff. They know what they've got to do. We are cutting through the bureaucracy. We are creating more dynamism in the team. It's also a great way to integrate the acquisition we did. We would have never been able to retain the manager of the company we've acquired without having this strategy. This is creating a new spirit and a new engagement in the company, which is absolutely critical to our success. As an example, I've put here a list of the senior management team that we have been able to attract or retain in the past years. It's just an example, but it's to show you that we have been able to attract people from very diverse universe outside the insurance industry. We've kept most of our IFA or brokers teams. We've been able to attract people from the asset management world. The last to join us is Colin Williams, so he's coming from Fidelity, where he was running the DC pension at Fidelity. We've got also Richard Philbin that joined from FNC. All this new blood is enriching our teams and allow us to have a different thinking than the traditional thinking. Most of them have been entrepreneurs before, and so they are bringing a new flavor to what we do. If we look at some of the important things that we've been doing in the past years, working on the brand not only to increase the brand recognition of AXA. You've seen some research on the AXA brand in the UK. It's now the second brand in the UK market. But also we have had, through this SBU structure, a segregated approach to the brand, trying to brand differently depending on the segments of or target segments that we were looking at. So Sun Life Direct, for example, which is our direct protection brand, is selected to this offer, and we've decided to drop the AXA brand from this because it was not aligned with the target segments we were looking at. In the past years, we've also focused a lot in customer satisfaction and employee engagement. We believe that we've got a lot of propositions that are very well ranked in the market. Last week, Winterthur Wealth Management have won for the third or fourth years in a row a 5-star service award, both for its pension delivery and investment delivery. But our platform, Architas, our platform, has also been rated 5-star, and our protection proposition is also very well rated. I would add that on an employee engagement point of view, we have been now ranked twice last years in the top 20 from the Sunday Times as large companies to work with. So we've done a lot of work in the past years on the softer element of our businesses, increasing brand, increasing customer experience, employee engagement. It has been quite successful, as in the past years we are now able to sell the service differentiation. Let's move on the delivery of a better operating model. So here we'll talk about capital usage and expense. We've been also working on our balance sheet on one side and our new business strain on the other side, on the life strategy. The balance sheet had allowed us to reduce the use of capital through aging of equity or to the restructuring of our book of annuities in our with-profit funds. And we are now working on the release of 1 billion of capital from our back books, mainly the with-profit funds. And this should be doable in 2011. We are putting here 2012. On working on the new business strain, we cut commissions on corporate pension this April. We are looking at our wealth management, single pension and unit-linked bond to reduce the weight of platforms. We believe that with the experience of Winterthur, which was a fee-based company, we've got the ability to focus only on a fee-based advisor and transforming our business only on fee product. This is a journey, we are going through it. You can see the impact here of the life new business strain from today to 2012, given the transfer on platforms that we are looking at right now. On the cost side, very early in the process, we've looked at reducing our costs. We did a lot there in terms of outsourcing our life back book to Capita. In fact, realigning with our SBU model our support functions, which has led to a 50 million reduction in our cost base, and the decommissioning of our life legacy systems that is now going on. We've also merged the wealth management team, Elevate and Architas, and you can see that we expect to deliver in 2012 a cost savings of more than 200 millions. Now, let's focus on what we've done in order to optimize our distribution. And here we'll focus on the direct strategy in P&C, on Bluefin, and the work we do on partnerships. So we bought SwiftCover 3 years ago. Since then, we nearly multiplied by 10 the number of policy in the book. I would say that we've benefited from the aggregator factor because we've got a proposition that is particularly well fitted to aggregators. It's an internet-only proposition. And now we are launching an AXA product that will supplement the SwiftCover product. This AXA product will be differentiated as it will go more toward the good drivers. And this is now put online, so you can go see it now on the AXA website. It will be put on the 3 main aggregators by the end of the year. This is going done now and being advertised in February. We believe that this type of distribution gives us a huge advantage from a cost point of view and also from a distribution point of view. The target in 2010, given the increase in rates that have been going through in the past year, is 102, which is quite aggressive given the investment we put in this new AXA product just right now. The other development we've done in the past 3 years is the investment on the distribution through brokers, the purchase of brokers. In these past years, we've created the second SME broker, which is broking around 750 million pounds, specialized on SME and the mid-market. We've created the 5th EB business in the UK and a wealth management business that is advising that has assets under advice of around 500 million pounds. These brokers are of a huge strategic value to us, and we are developing them, and we are focusing on the development of them. So far, we are still in consolidation mode for Bluefin Insurance, but we are beginning to see synergies and business flowing in from Bluefin Wealth Management and Bluefin EB business, where we use our platforms to gather more assets. In the past years, we've developed a lot also partnerships with leading organizations, but we've also done some reorganization, and we exited unprofitable partnerships. So we've exited the MGAs with Primary, we've renegotiated our MGAs with Towergate, and we've exited the main loss-making partnership with Lloyd's, which was the Lloyd's Travel book and the Lloyd's SME book. As you can see, this begins to be quite a large part of our business, especially in terms of NBV contribution on the life side. And that's something we intend to develop, taking, in fact, benefit from the weakness of the traditional bank insurance player in the UK. The last part of our strategic agenda is to enrich our customer proposition. So here again, we will try to look at a sample of what we've done. And the first one is our wrap platform. We believe that our wrap platform, so we've got great ambition for it. Our target is to have 9 billion under administration by the end of 2012. And we intend to develop it in many ways. The first one is to develop it is the traditional way, which is to go after IFAs. But we want also to, given RDR, use the bank insurance channel, the affinity channel, and the direct channel to sell our investment proposition. And this is being developed right now. We believe that direct should be a way forward, or also white labeling with some affinity partners in another way to do that. We believe that our proposition is quite differentiated. We have a dual pricing structure. So we, despite some of our bigger competitor, we are RDR ready, and we will not need to re-platform or to do something in-depth technological change in order to have this dual pricing structure. Architas was developed 2 years ago also in order to capture and to procure better the asset management services. We've got now £2 billion under management. This year, through our big bank insurance deal with National Australia Bank, we took over 900 million of funds. This is the focal point of the development of our investment proposition within AXA UK. But we are also supporting the whole of the AXA group in being, in fact, the hub for the procurement and the design of financial solution using external provider for the UK. We are for Europe. We are trying here to recapture part of the margin that is lost through open architecture. And as we believe that for affinity customers, this will be the main development and the main growth model in the future. This is a must-do for us. PPP. PPP is the second largest private health insurer in the UK. It's a £1 billion company. We've got 30% market share, and it's very profitable. Our strategy here is to maintain our market share and our profitability in the UK and focus on the development of our international proposition, especially in developed market and especially with the support of our local AXA companies locally. So we are working in Asia today in Singapore, Malaysia, Indonesia, or the various countries that you see here that we call the Smith countries, and in the Gulf. We've got joint venture with these AXA companies. We are providing not only technical support for them to develop a local proposition, but we are also proposing to expatriate high net worth individual or corporates in the region, health cover that is more UK-like, I would say. And the development of this market is is huge. It's not so competitive today, so we believe that it's a way also to play the emerging market growth, proposing, our expertise to these markets. So to conclude, our strategy was established in 2007 when I joined AXA UK. We have been quite dynamic in the implementation, and we've accelerated most of the work we had to do. We've accelerated both on the capital and expense efficiency side, but we also accelerated in the decommissioning of our old world and our move to the new world. Now we'll have to go back on the field in the UK to explain our strategy to the staff because it's quite tough for them. We are just in the middle of decommissioning something and recreating a new world, and we need to give some legibility and visibility on this action, as it's something that is difficult to see right now in our figures. Now I'm very confident in our 2012 targets, in our strategy. I believe that the move of platform in the UK, which is today only 40% of the new business on platform, where when you look at Australia, 90% of the business is on platform. I believe this move is a move that must be done, and when I'm looking at acquisition in the UK from time to time, I'm dreaming. I'm immediately saying, no, we should not do that. We would have to do it again. Decommissioning an IFA business from commission-based to fee-based is complex. It requires a lot of investment in a personal and cultural, and I believe that having done it, we are very well positioned for the growth in the future. Thank you.
We are going to start the US session. Presenting today will be Kip Condrum, Chief Executive Officer of AXA Financials, and Peter Kraus, Chief Executive Officer of AllianceBernstein. Presentations are expected to last around 20 minutes, and the Q&A session around 25 minutes following the presentation. Thank you. Kip, the floor is yours.
Okay. Good afternoon. I wanted to make sure that I knew which one of these to press. I wanted to just sort of give you a quick update on the U.S. business, particularly the variable annuity. Could you go back one slide, please? Because I think this is the second slide. Thank you. First of all, the business drivers, as you all know, equity markets, interest rates, and volatility have really altered the landscape for our business. Competition has changed, and we've gone through a year where competitors' approaches have varied, but everyone's de-risked their products, some more than others. And market share data is all over the place. And basically what's happening is, as companies are taking products off the market, they have to give notice that they're doing that, and they end up with a fire sale. When we went from 6% on our roll-up rate to 5% in the first quarter, we had a fire sale on the 6% product before it came off the market. And as each company has done that, you've seen market share swings that have been extreme. For example, in the third quarter, the top 3 companies had 40% of the market share total. You've never seen anything like that before in the variable annuity business. So I think just one word of caution: market share data is less reliable this year than it probably ever has been in the past. But what hasn't changed is the fact that retirement planning is a key part of the need of the American consumer. Their savings needs are short. They're far more risk averse after having gone through 2008, and they're less focused on inflation. We actually think they should be much more focused on inflation. Just a quick recap on our sales for the first half of the year. In annuities, we were in the number 4 position with a 7.7% market share through the second quarter. Third quarter data is out. We fell to the number 5 position in the third quarter, not surprisingly, based upon what I just told you about the top 3 companies. The captive channel, our 6,000 agents, is number 2 in annuities with a 12% market share in that channel. And our third-party sales are number 7, the 5.5% share. In the K through 12 marketplace, which is teachers teaching kindergarten through the 12th grade, the 403B business is sort of like a 401k business for teachers and hospitals and so forth. We're very, very big players there. We have about a 20% market share. Products are very low risk. Basically, they're investment products with a tax wrapper, and they have a return of premium death benefit. We've been stealing market share all year long because VALIC, owned by AIG, and ING are also big players in that market, and we've been stealing share this year from them. We have 1,000 agents who don't do anything but sell to that market. So it's a great growth business for us, and it continues to grow. On the life insurance side, sales have been consistent through the first 3 quarters of the year. We're number 13, and remember there are a lot of life-only players, mutuals in the U.S. that rank at the top end. Our captive agency force ranks number 8 with almost a 4% market share, and we're number 3 in variable life, and in our captive agency force we're number 1 in variable life. That's a big opportunity. Variable life sales overall are down this year because it's variable and it's tied to the stock market, but we have a new product coming out in a couple of weeks that we think will make a big difference there. Risk management wise, our priorities are the same. We've been continuing to enhance the risk management in our in-force. We've substantially reduced the risk of our in-force. We've done 2 major things there. In terms of hedging the basis risk, we moved over $30 billion of assets to index and enhanced index. So if you had a repeat of 2008, our basis cost would have been reduced by over 2/3. The second thing we did was we put a volatility tool into our portfolios. Currently it's in 45% of our portfolios, and by the end of the second quarter it'll be in 75% of our portfolios. And basically what that does is as volatility starts to rise, we raise cash in the portfolios, thereby mitigating our cost of volatility, but at the same time we would create a substantially risk-adjusted better return for our clients. So it's a win for us and a win for our clients. So on a risk management basis, we've been doing that, and as we're developing products, we're looking at all the risk metrics and designing around them, and I'll get to that in a minute. On the product innovation side, there are 4 things that we're doing simultaneously on the product innovation side. We're looking at the fact that clients are much more risk adverse than they ever were before. We're looking at the fact that inflation is 0, but government spending in the U.S. is greater than it's been since the 60s. And so you have to be over 50 years old to remember inflation. And we think inflation is a critical risk, and we're designing products around that risk. Thirdly, interest rates are at their more than 50-year low, and they're being held artificially low in the U.S. by government fiscal policy. And so planning for rising interest rates is a third thing that we're designing around. And the fourth thing that we're designing around, with all the government spending, it's inevitable in the U.S. that taxes are going to rise. And one of the features of variable annuities is that whatever is accumulated inside the annuity is not taxable until the money comes out. That hasn't been particularly attractive in the U.S. for several years because dividends are taxed at 15% and capital gains are taxed at 15%. So the tax advantage feature of a variable annuity has not been attractive. We think it's going to become attractive, and we see that as a big opportunity. So we're designing around those 4 client needs, and I'll come back to how we're doing that in a minute. From a profitability standpoint, we've done a lot of things to maximize the profitability of our in-force, as I mentioned, and we're building a much more diverse and resilient pool or group of products as we go forward. Talk about that in a second. And from a capital management standpoint, we're continuing to look at ways of creating products in the marketplace that are attractive, that eat less capital than some of the products we've had on our books in the past. So we're building a much more diversified product portfolio. In the annuity category, the main product we've had in the marketplace for several years is the accumulator product. It's been out there by itself. We're adding a product to accumulator this month, and we'll be adding another product in June. So we'll have 3 products in the marketplace by the middle of next year, which will be a first for us, on top of the product that I mentioned in the kindergarten through 12 marketplace. We're focused on the diversification side. The annuity side, we've developed a product called Retirement Cornerstone. And I'm going to talk about that in a minute, but the Cornerstone product is a unique product that is designed to look at the issues around inflation, to look at the issues around interest rates and taxes, and it's designed to solve problems in all of those areas. We're doing protection equity products. That's the product we anticipate having out in June. Basically, it'd be a S&P, tied to an S&P index, but it would protect you down a certain percentage of S&P decline before you would lose money against a cap on the upside of some number. So just for illustration purposes, say it would protect you down the first 10% that the S&P went down in a particular year against capping you at 12% if the S&P went over 12% in that given year. All the focus groups and all the work we've done with our annuity partners suggests that that product would be very attractive in the marketplace. Very low risk product, very easy to manage, and potentially quite profitable. And we're also looking at other kinds of non-guaranteed products in the variable annuity space because we think the tax sheltered feature is going to be pretty attractive. So the simple concept of a wrap account or a mutual fund and a tax wrapper all of a sudden becomes something that I think is going to be very attractive in the U.S. going forward. On the life side, we've been the biggest player in variable life, but the problem with variable life is people have become more risk adverse. And we all know that variable life is the best product for clients. It's the best product for us, but it does have volatility. So we're putting a structured account inside that product, which is coming out in a couple of weeks. It's going to protect the client down 25% against the Standard & Poor, against a cap at 17 on the upside. We think that that's going to open up the variable life marketplace for us because it's going to allow clients to feel like they've got a fixed product with upside opportunity. So I think that that's something that looks pretty good for us. And then the variable universal life area will continue to expand for us as we look at other innovations going forward. The retirement cornerstone product, I would sort of introduce it this way. The products that are in the marketplace, including ours, all have a fixed roll-up rate. Typically in the marketplace today, it's 5%. As I said, interest rates are at their all-time low. Inflation is at 0. If inflation goes up, interest rates go up and bond prices go down. If inflation goes up, history says that stocks don't perform particularly well. So people's real account, where they're investing the actual dollars, may not perform well if we have rising inflation. And if they have a fixed rate roll-up rate, they're going to be locked as interest rates start to go up. So we designed this product, on the one hand, to have a unique guarantee, on the other hand, to solve a problem that's been created in the variable annuity marketplace by all of us as we've de-risked our products over the last year. We've reduced the amount of equity exposure we've allowed clients to take. We've reduced the number of funds we've allowed them to invest in so that we could hedge efficiently, and we've pushed them more often into asset allocation portfolios. Well, this product is designed to have an investment sleeve which will offer some 97 different funds, mostly Morningstar 4- and 5-star funds, that will allow clients to invest on the non-guaranteed side in almost anything they want, and then roll their alpha created assets over to the guaranteed side. And they can do it on a dollar cost averaging basis, or they can do it at will. So the guaranteed side of this product is quite unique in that it has a roll-up rate that moves with interest rates. It's tied to 100 basis points over the 10-year. It floats once a year. So your roll-up rate will float from a floor of 4 to a ceiling of 8. Today, the 10-year is about 330, 340. We're introducing the product in the next week or so. We'll introduce it with a teaser rate of 5% for the first year, and then at the end of the first year, it'll adjust based upon where interest rates are. If you track the product, if it were in place for the last 50 years, it would have had an average roll-up rate of 6.6%, and even over the last 10 years, it would have had a roll-up rate of 5.5%. So the product, we think, is very timely. It's designed to be out there before inflation comes, before interest rates start to rise. But by introducing it with a teaser rate of 5%, and a floor of 4, we think that the marketplace should react pretty positively. Plus, having all the investment opportunities on the non-guaranteed side, we think offers a lot of opportunity as well. From our perspective, it's an extremely efficient product. It eats significantly less capital than any other GMXB product we've had in the marketplace. The size of the hedges would be much smaller. Remember, we're typically only hedging a year's interest rates at a time, so we don't have as much convexity risk as you would have in a normal 20, 30-year hedging program. And the new business value margins are robust at about 30%. So it's a great product. We're going to introduce it. We're waiting for final SEC approval. Interestingly, SEC is not an issue typically in approving a product. This is a game changer, and it's taken them a while to just go through the process because they've never seen anything like this before. This is the first product we've introduced in the 8.5 years I've been at AXA that isn't an iteration of a former product we had in the marketplace. This is a brand new platform, brand new product. We've gotten very strong feedback from all of our partners, from our own sales force and from the focus groups that we've had, so we're very optimistic about its future. I think I covered most of the points on here. The product is ready to go. In our retail sector, we're going to offer it first to our 6,000 agents. It'll take us until March to get it connected from a systems standpoint to the third-party providers, the brokers and the financial planners and the banks. So we'll be introducing it March 1st in those channels. And the product will be running alongside of our existing accumulator product that's in the marketplace today. So I think the big news from the U.S., if I could summarize for you, is that the marketplace is changing. It's been a crazy year as people have de-risked products and had fire sales. We think that the platform is changing. We think that this is the kind of product that clients are going to want, and we think it's appropriate for the future. So I'll answer any questions you have after Peter finishes his remarks. Thank you.
Thanks, Kip. So obviously, we all lived through a pretty difficult time period. In the 6 months ended March 31st, 2009, it was probably the most dangerous and difficult capital markets that we've seen, and hopefully that we will ever see. Out of that, however, there's lots of lessons to be learned. And as we think about AllianceBernstein and the things that we want to accomplish going forward, there are 4 elements to that I'd like to talk a little bit about, and then we'll get into the slides. Number 1 is credibility, safety, sustainability in a regulated entity. So investors want sustainability out of the entity that they're investing in. They want that entity to be regulated by appropriate regulators, and they want it to be safe, and they want it to be stable. Secondly is they're interested in asset allocation. They want to be sure that they're getting good advice on how to allocate their portfolios, because it's clear that if you had good advice and asset allocation sophistication going through this time period, your returns would have been more attractive. Third is they want product innovation. They want investors to be able to say, what new ideas, what is the new opportunity to invest in, and how do I take advantage of that? And last, they want consistency of investment personnel. So those 4 things are all elements of what we're trying to focus on as we go through 2009 and begin our new year in 2010. Now let me talk a little bit about what's most important to investors, of course, which is performance. So in 2009, we've had a significant turnaround in our performance from that which we experienced in 2008. The value product is, at the present time, top quartile for third quarter 2009. And as you see, 2 out of 3 of the concentrated services are actually top decile. Fixed income has had outstanding performance as well. And if you actually put together the 2009 outperformance and 2008 underperformance, it's basically break even to, in some cases, actually net alpha that's being created. Growth product, the U.S. large cap growth, which is one of our longer investment services, longer term investment services, was top decile for third quarter 2009 and top quartile for 1 year. And blend, which is the large amount of assets that we manage for global portfolios, has also been in the top half for the third quarter 2009 and year-to-date 2009. And lastly, very good performance for mutual funds. 69% of the mutual funds are in the top 50% of their peer group. So much better performance for us in 2009 And that gives us an opportunity to show to clients what we believed we could do, which is continue to produce alpha and outperformance for them and their portfolios over time. The next slide talks a little bit about net flows. Now, the word net is important because obviously there's two things going on. There's sales and there's outflows. And if you look at that chart, what you'll see is the net numbers from the fourth quarter 07 through the third quarter of 09. Obviously, there's a declining red line, which reflects the net. But what's really interesting is if you actually looked at the fourth quarter 07 to the fourth quarter 08, and you looked at net outflows, you'd see outflows, and that's the peak of the outflows, were $10 billion greater than the previous fourth quarter. If you actually, staying on the outflows for a second, if you actually looked at third quarter 08 to third quarter 09, actually the outflows are the same, no change. And if you look at the outflows over the entire time period, fourth quarter 07 to third quarter 09, the outflows are only $2.8 billion greater in the third quarter of 09. So clearly there were outflows, and that negatively affected asset levels. But the bigger issue is on what was going on in sales. And if we look at that, again, we'll do the same math. Fourth quarter 07 to fourth quarter 08, that's 20 billion less. If you look at that third quarter 08 to third quarter 09, it's actually 800 million more. So gross sales beginning to rise. And over the entire period, it's $18.5 billion less. So what's actually going on out there that's creating this, this sort of dichotomy between gross sales and outflows? Well, first of all, pension plans around the world were raising cash. During the fourth quarter of 08 and the beginning of 09, the ATM machine for the pension plans of the world was their equity portfolio. Couldn't sell debt, couldn't get out of hedge funds, couldn't get out of private equity, so they sold their equity portfolios, and they sold them aggressively. Secondly, we've seen very little rebalancing as equity markets fell, and frankly, as equity markets have come back. So small inflows, small opportunities to actually sell the traditional risk products. And last, that just general de-risking of investors has really led to a fall in risk assets around the world. I suspect, and this is just a prognostication, that by the end of 2010 and into 2011, investors will begin to re-risk their portfolios. They will begin to come back into risk assets, both in the fixed income markets as well as in the equity markets, but importantly in the equity markets. I also think that now that our core performance is stronger, the question is what can we do on the sales side that's more unique or different? And I mentioned product innovation. And so product innovation is a focus for us, and two things. One is taking the core investment services and using them to actually produce new and innovative opportunities. And secondly is actually having new products. And an example of that for us is real estate. If we go to the next slide, I'd like to talk a little bit about what are investment themes for us this year. Thematic investing. Investors are very interested in global thematic changes. And there are 4 themes for us in this area, and there's an overlay across the top of them that is a research effort that we also engage in, and that's called Research for Strategic Change. The purpose of the Research for Strategic Change group is actually to identify powerful and disruptive themes around the world. Juxtaposed to our more than 100 fundamental analysts who are bottom-up analysts, it's a pretty powerful mix. So these two forces are looking for fundamental thematic changes in the investment world that we can take advantage of. I'm going to give you 4. First, genome. DNA sequencing is obviously something we all know about. It's looking at the building blocks of life. What's more important is that it gives us an opportunity to actually identify where there is opportunities for preventive care, diagnostic services, and drug delivery that are unique and different and will grow sequentially in the future. Second is climate change, a story that we all know about. And there is, of course, the shotgun opportunity of investing in biofuels, wind, and solar. We're more interested in finding, for example, transmission vehicles that are smart, that actually can utilize solar and wind power as well as traditional forms of fuel. A third opportunity is what we would call Web 2.0. Really, it's moving to utility computing. So away from the traditional hardware and the disappointing potentials of traditional hardware refresh cycles, and looking at software and infrastructure as a service. There are opportunities to identify entities that actually have large computing capability, both data storage as well as computing capability, and how they will be used as a utility in the future, and how others will actually outsource to those capacities, give us methodologies to invest over the long term across that theme. And last, in emerging markets. Now again, not an original theme, but the magnitude of what the changes in emerging markets are, we think are unique. So for example, consumption in China is viewed to grow at 10 to 15%. That's sort of the consensus. Our view is that that is probably 20 to 30% growth, and for a much more lengthy time period, a more sustainable time period. So if you believe that, and we're right, that's an attractive theme on which to invest. Second bullet point is unconstrained investing. So investors are saying to us, listen, we understand constraints are expensive. So when we say to you, just take our money and put it in equities, or just take our money and put it in fixed income, that's a constraint. If we say to you, here's our money, we want you to actually produce returns as best you can from a risk-return point of view, where would you put it? Well, we might invest in debt, we might invest in equities, we want to be able to go up and down the capital structure, and so unconstrained investing is an interesting opportunity that our clients are asking us to take advantage of. Given our global research platform and our capacity to basically marry both fixed income investing and equity investing, we think we're able to do that, and in fact are originating certain products and investment services to capitalize on that. Distressed credit, I think, is obvious, both on the corporate side, the mortgage side, and the asset-backed side. Asset-backed business has been TALF as an example of that. On the mortgage side, PPIP, and the corporate is just our traditional investing. Distressed real estate, we've actually engaged in building that business. We've hired 2 very senior people to build a opportunistic real estate business, probably first starting in the United States and then going global. We think this is a long-term theme. We believe that 2010, 11, and 12, there'll be interesting opportunities to invest in that distressed area. Again, the capital structure of real estate is distressed. You can invest in the equity, you can invest in the debt, you can invest in mezzanine debt, senior debt, junior debt, all kinds of different opportunities that you will be able to take advantage of and produce an attractive return. And last but not least, individual stock selection. So we know that this is a time period in which fundamental investors believe that by identifying stocks and having different points of view that you can create outsized returns. We've seen that so far in our business in 2009, and we believe that that will continue through the balance, obviously, of this year and well into the next few years, and we intend to take advantage of that. The last slide is we have been hard at work trying to create more operating leverage within the business. As you all know, asset managers are terrifically profitable when assets grow. The opposite happens when assets erode. And so our job this year was to basically reinforce or restore that operating leverage. So there's lots of numbers on these pages, on this page, but I'd just like to walk you through it conceptually. So what we said is that our adjusted revenues for the year ended September 30th, 2009, if we did nothing to our expenses, would have resulted in net income of $237 million, or a margin of 11%. However, if we did what we did, i.e. the people that were terminated, the changes that were made in personnel, the changes that we've made in G&A and expenses, if we did that at the beginning of that year, our margin would have increased by almost 10 points to 20%. That's a substantial amount of operating leverage. That reflects a 20% reduction in headcount and substantial reduction in G&A expenses. All of those opportunities are now available to us in the next year, 2010, and beyond. So with that, I will leave it for Kip and I to answer questions.
Hello, everybody. We're going to start the session of the afternoon. Thank you for being here again. So welcome to the P&C Operation workshop. Presenting will be François Persion, Chief Executive Officer of AXA France and member of the AXA Management Board. So, like this morning, the presentation will last 25 minutes. You will have the possibility to ask questions to François Pierson and François Bicchini, who is the Chief Executive Officer of AXA Cession, our reinsurance captive. The question will last 20 minutes. Please just raise one question at a time so that everybody has the ability to raise questions. The presentation will be in French. Now I leave the floor to François.
The first question is, are you still alive after this busy? Yes, it's a good thing. The second good news is for me, I will speak in French. I am very sorry, but it's mainly by courtesy and respect for the English language. It's not for me. Ce que je vais essayer de vous dire maintenant, c'est de vous dire que dans le business P&C, dans AXA, on y croit. On est très nombreux à le faire, qu'il y a de nombreuses équipes au travers le monde et qui tous les jours essaient de faire un peu mieux leur travail que hier, et que dans les périodes qui viennent, eh bien, nous sentons prêts à affronter ce nouveau cycle. Et c'est à peu près ça que je vais vous décrire, en commençant par vous donner une vue générale de l'activité P&C en Europe, d'AXA, mais enfin c'est 86 à 88% de notre business P&C dans le monde. La deuxième chose que je vais vous dire, c'est que nous sentons et nous sommes prêts pour affronter donc le nouveau cycle. La troisième chose, c'est que nous avons dans AXA des leviers de croissance additionnels, tant à l'intérieur de nos activités habituelles que sur des activités nouvelles dans des pays nouveaux et sur des modes de distribution nouveaux. Voilà la répartition de ma présentation. Alors, première chose, description de notre fonds de commerce. Donc, c'est à moi de faire le truc. Voilà. Description de notre fonds de commerce, des positions importantes en Europe, un business très diversifié et un historique de croissance et de profitabilité qui parle pour nous. Alors, la première slide, bon, c'est une vue d'ensemble de notre part de marché dans les pays européens. Vous voyez que dans 6 pays, nous sommes soit en position numéro 1, soit en position numéro 2 en termes de part de marché. L'assureur AXA est le premier en Belgique, en France et en Suisse. Ce sont des positions qui sont sur ces marchés effectivement extrêmement importantes. Et sur les marché de UK, de l'Allemagne et de l'Italie, vous voyez que là où il y a un grand champion local, eh bien nous sommes soit en position d'outsider, soit tout simplement nous avons des positions relativement importantes. Ce qui est noté sur la slide en bas à gauche, il est noté l'importance de nos réseaux d'agents généraux et distribution propriétaire au travers de ces agents. Vous avez vu qu'il y a 15 000 agents en Europe qui distribuent du P&C. Nous pensons et nous croyons que c'est un avantage supplémentaire par rapport à nos concurrents. Les agents en période de crise, ce sont des intermédiaires qui sont plus fidèles, je veux dire, qui sont en tout cas plus capables d'affronter les difficultés du temps, y compris les augmentations de tarifs quand c'est nécessaire. C'est un réseau qui a une meilleure taux de conservation de ses clients que les autres. Et enfin, c'est un réseau qui est une des compétences, je veux dire, majeures d'AXA et sur lequel nous chaque année, nous essayons de progresser dans la façon de piloter ces réseaux. Sur la droite, il est indiqué que, bien sûr, nous sommes investis donc sur cette distribution traditionnelle, mais nous avons construit sur les marchés européens une plateforme de direct qui nous donne aussi un peu plus de puissance de développement que celles que nous obtenons par l'intermédiaire de nos réseaux propriétaires, qui sont donc les agents, mais aussi les courtiers. Sur la slide 2, voilà, nous avons un portefeuille diversifié pour plus de sécurité, moins de volatilité. Nous avons un portefeuille sur tous les risques du dommage. Nous ne sommes pas qu'un assureur automobile, même si nous avons 34% d'assurance auto 4 roues dans notre portefeuille. Nous sommes aussi un assureur. Notre chiffre d'affaires est réalisé dans l'essentiel, enfin dans la plupart des pays européens. Et vous voyez que notre chiffre d'affaires n'est pas détenu uniquement par les activités françaises. Nous avons aussi une distribution, nous sommes équilibrés, c'est-à-dire nous savons, même si le réseau d'agences est un avantage extrêmement important, il y a des activités qu'on ne peut pas faire véritablement avec des agents généraux. En tout cas, on doit évidemment être aidé par la distribution et par les courtiers, notamment sur le risque d'entreprise. Vous voyez que 51% distribution propriétaire, 49% non propriétaire, c'est équilibré. Nous n'avons pas les deux pieds dans le même sabot, si je peux m'exprimer ainsi. We don't let the grass under our feet. C'est une traduction de la première phrase. Nous avons aussi un portefeuille qui est équilibré entre les risques du particulier et les risques d'entreprise. Dans les pays, en France, en Suisse et en Italie, nous avons évidemment beaucoup de risques du particulier, mais aussi nous avons ce risque d'entreprise qui n'est pas représenté par du grand risque. C'est du risque SME, c'est du risque moyen, ce qui nous fait dire que nous ne sommes pas sous la contrainte d'un seul ou de quelques dizaines ou centaines de grands clients. Nous avons un portefeuille extrêmement important en nombre de polices. Mais ce qui veut dire aussi que notre chiffre d'affaires peut croître à l'endroit, notamment sur les commercial lines, qu'il y a de la place pour le développement de nos activités. C'est ce que nous verrons dans un instant. Le passé plaide pour nous. Le passé plaide pour nous. Nous avons une croissance sur la période 2000-2008 qui est supérieure à celle de nos pairs. C'est-à-dire nous avons voyé une croissance moyenne de 7% par rapport à un marché par rapport à nos pairs qui était à 4%. C'est vrai que nous avons acquis Winterthur et que c'est, quand on additionne 10 milliards de cotisations entre 2000 et 2008, il y a Winterthur au milieu, mais avant l'acquisition de Winterthur, nous avions une croissance supérieure aussi à celle de nos pairs. Nous avons eu cette croissance tout en améliorant notre ratio combiné, et tout en ayant un ratio combiné supérieur à la moyenne du marché, mais il faut savoir que nous estimons que cette différence est plus due à notre portefeuille composé de plus de branches longues, et particulièrement en France, qu'à un moins bon management des activités techniques. Nous avons d'ailleurs eu pendant cette période une conduite prudente de nos réserves techniques, et d'ailleurs nous voyons que nous avons un taux qui est supérieur à celui de nos concurrents. Alors maintenant, je passe au chapitre suivant. C'est dans ce cycle qui s'ouvre, est-ce qu'on va être capable à la fois d'augmenter les prix parce que les marchés se sont détériorés en Europe? Est-ce qu'on va être capable de garder nos clients en augmentant nos primes? Parce que c'est ça quand même qui est aussi extrêmement important. Eh bien, c'est ce que nous pensons, et nous allons montrer dans quelle amplitude nous pensons pouvoir augmenter nos prix. Nous allons être aidés aussi dans l'amélioration, dans le pilotage de notre rentabilité technique, par notre programme d'économie sur les claims, et nous allons aussi être aidés par notre habituelle prudence dans notre souscription et dans nos programmes de réassurance. Alors, augmenter nos prix. Ça, vous voyez, en fait, on parle de prime moyenne ici. Et, nous serons à la fois attentifs et fermement orientés sur cette augmentation de prix qui est justifiée. justifié par ce que le résultat sur l'automobile principalement, sur l'habitation aussi, par le résultat de l'ensemble des assureurs, qui viennent aussi d'une année 2009 qui a quand même été véritablement détériorée par les tempêtes et par les inondations. Donc mais nous allons le faire d'une façon à la fois raisonnable et en tout cas qui va tenir compte de la situation de chacun des marchés, de chacun des pays. Nous ne voulons pas sortir des marchés, mais nous voulons profiter de l'orientation générale pour pouvoir augmenter nos prix, tant sur l'automobile que sur l'habitation, que sur le commercial property, enfin sur toutes les lignes de business. Mais vous voyez que l'encadrer de prix moyenne entre 1% et 5%, c'est raisonnable. Ce qu'il faut, c'est pas faire le contraire, c'est-à-dire rester sur un trend de baisse de sa prime moyenne, comme on l'a vécu ces dernières années, particulièrement sur le moteur, puisque ça fait plusieurs années que ces primes moyennes baissent. Aujourd'hui, la sinistralité du fait d'un certain nombre de choses, sur notamment cette branche d'activité, a augmenté. Baisse du prix de l'essence, augmentation du nombre de kilomètres parcourus par les clients. Les autoroutes français n'ont jamais enregistré autant de tickets de péage, je veux dire. Donc ça, c'est un signe qui ne trompe pas. Eh bien, il faut, et je crois que tous nos compétiteurs, évidemment, je ne les citerai pas, mais tous nos compétiteurs vont suivre cette tendance. Ce qu'il faut que nous arrivions à faire, c'est ce que nous avons réussi à faire dans les années passées chez AXA France, c'est-à-dire que quand on a augmenté nos primes, on a gardé un peu mieux nos clients que nos concurrents. Et ça c'est vrai sur les périodes qui sont observées de 2003 à 2006, et vrai sur les périodes de 2007 à 2009 en France. Eh bien, cette méthode, qui est évidemment basée notamment sur la segmentation des prix, sur la segmentation des portefeuilles, mais cette méthode, nous souhaitons l'étendre à l'ensemble du portefeuille d'AXA. Alors, sur la slide d'après, augmenter ses prix, c'est bien, mais il faut continuer à être attractif pour ses clients. Et ce que nous savons, nous et d'autres aussi d'ailleurs, c'est qu'un client très satisfait, ça résilie 3 fois moins qu'un client très insatisfait. Alors ça paraît, quel que soit, hors considération de prix. C'est sur les niveaux de service. Donc nous sommes arc-boutés là-dessus et sur le fait de mesurer chaque année, et depuis quelques années, en tout cas depuis 2006, le taux de satisfaction de nos clients. Et vous voyez sur l'histogramme droite en haut qu'il a augmenté. Et c'est ça que nous pilotons au travers d'un certain nombre d'initiatives que j'ai rangées en divisant ce slide en 3. La première chose, c'est que nous avons la chance de bénéficier d'une marque extrêmement attractive. Nous sommes vus comme l'assurance, la marque la plus connue dans le monde. Et ça, c'est un avantage évident. La deuxième chose, c'est la qualité de service, c'est-à-dire que nous essayons, vous voyez que dans l'histogramme, que nous avons 129 programmes de fidélisation mis dans l'ensemble des pays européens pour améliorer la qualité de service et en tout cas pour augmenter la satisfaction des clients. Et dans ces programmes, ce sont des choses véritablement palpables. Je prends un ou deux exemples. En France, quand la dépanneuse d'AXA Assistance arrive 1 heure après que vous l'ayez appelée, eh bien, nous payons à la personne qui nous a trop attendu une pénalité, c'est-à-dire nous payons entre 100 et 150 euros à chaque fois où nous sommes défaillants, c'est-à-dire que nous avons mis un peu plus de temps qu'1 heure, que c'est notre promesse, et quand cette promesse on ne respecte pas, on paye. En Italie, quand on met plus de 21 jours à payer un sinistre, on paye là aussi 100 euros, ça c'est une promesse que nous tenons aussi. Ce genre de promesses qui sont très, très factuelles, en tout cas qui sont dans du cash, je veux dire ça. emmène les équipes derrière à respecter les engagements que nous prenons. Parce que à chaque fois que nous sommes défaillants, nous le comptabilisons. Et évidemment, personne dans AXA, y compris les équipes, n'a envie de voir ces pénalités que nous infligeons croître. Sur le risque d'entreprise, on peut prendre encore un exemple. Chez AXA France, nous avons pris l'engagement de répondre aux cotations de nos courtiers en moins de 72 heures, après avoir observé que les courtiers venaient plutôt nous voir pour les grandes affaires, parce qu'ils savaient que nous avions les équipes capables de les coter, et ils oubliaient de venir nous voir pour les affaires de petite taille, disant ça, c'est pas la peine d'aller voir AXA, les autres le font beaucoup plus vite, c'est-à-dire que nous avions un portefeuille déséquilibré, plus de grosses affaires que la moyenne du marché. C'est ce que nous avons voulu changer en instituant ce 72 heures chrono. Quand les courtiers viennent nous amener des affaires moyennes, 72 heures après, ils ont leur cotation, et croyez-moi, ça a changé le profil de souscription d'AXA Entreprise. Dernière chose, nous avons en 2009 1 380 000 clients qui sont dans des programmes de fidélité, des programmes qui leur concèdent des avantages parce qu'ils sont répertoriés comme des clients ayant plusieurs contrats, étant capables d'en avoir encore un peu plus, et des programmes de fidélité ont été mis en place sur le même module à peu près dans l'ensemble des pays d'AXA, c'est-à-dire en Espagne, ça s'appelle AXA Fideling, et non pas AXA Fidelio, mais bon, en France, ça s'appelle le Club Distinction, en Belgique, Papy Family, ce sont à peu près les mêmes programmes qui font que le client a beaucoup plus d'avantages à rester dans AXA que de nous quitter. Maintenant, passons à des choses plus sinistres, en tout cas sur les sinistres. Vous voyez que nous avons, là aussi, pour maîtriser notre rentabilité technique, augmentation des prix, conservation d'un taux élevé de rétention des clients, et aussi baisse et économie sur les sinistres. Alors, on a commencé bien avant 2009, mais maintenant, je pense qu'on est vraiment efficace pour mener ces actions. Vous voyez que notre programme d'économie sur les sinistres est ambitieux, puisqu'entre 2009 et 2012, on estime être capable d'économiser 750 millions d'euros de sinistres. Les opérations, c'est par le procurement. Le procurement, c'est majoritairement le taux d'orientation des sinistres automobiles, c'est-à-dire vers les garages agréés quand on a besoin de réparer une automobile après un sinistre. Nous sommes passés en 2008, nous étions capables d'orienter 40% de nos sinistrés. En fin 2009, nous sommes passés à environ entre 46 et 47% de taux d'orientation de nos véhicules accidentés, ce qui est un avantage important, en tout cas qui est en termes d'efficacité, en termes d'économie, extrêmement important de savoir à quel endroit on va faire réparer la voiture de notre client sinistré. Ça va généralement, il y a des engagements de rapidité, mais aussi il y a des engagements de prix. Et pour ceux qui connaissent le marché français, ils savent que les mutuelles, qui sont notre principal concurrent en automobile particulier sur le marché français, eh bien, sont extrêmement efficaces sur ce taux d'orientation. Entre 45 et 46%, on est vraiment sur très, très, très près de ce qu'ils sont capables de faire. Sur le leakage, c'est la gestion du coulage, hein, c'est-à-dire c'est les sinistres qu'on règle à peu près, qu'on règle pas si bien que ça. Donc on a une procédure qui nous permet, qui fait qu'on rouvre les sinistres une fois qu'ils ont été clos pour voir ce qu'on a fait. On a donc des sondages, et donc on vérifie quelles sont les erreurs les plus fréquentes, et après on les publie chez les régleurs sinistres pour éviter qu'ils les refassent après. C'est une procédure extrêmement efficace et donc qui porte en elle le taux d'économie, moins 30%, que nous envisageons de faire sur les sinistres. Sur la fraude, il faut évidemment en parler. C'est surtout en cette période, il n'y a pas forcément une augmentation de la fraude très visible, mais en tout cas, je veux dire, les assurés dans une période actuelle n'oublient jamais de faire les déclarations à l'assureur parce qu'ils estiment devoir récupérer toutes les indemnités qu'ils peuvent récupérer dans cette période, et de temps en temps, sans doute, qu'ils en demandent un peu plus à l'assureur qu'ils ont le droit d'en demander. Donc on a un programme de gestion de la fraude, là aussi extrêmement précis. Il a commencé en Allemagne, c'est eux qui ont bâti les outils, on l'étend en Italie, on l'étend en France, et pour le vol automobile notamment, nous sommes en train de monter des programmes où nous exigerons les retours des clés quand le véhicule sera déclaré volé et que l'assureur pourra récupérer les clés. Et nous avons déjà mis ça en place dans 1 ou 2 pays et nous voyons, les économies que nous pouvons en tirer. Le reste, et notamment ces others, ces sinistres corporels, vous savez que nous avons 300 000 sinistres corporels dans AXA. Ça représente un tiers de notre charge technique, donc ça représente autour de 5 milliards de sinistres. Nous avons là aussi besoin d'être extrêmement efficaces dans leur gestion, extrêmement proactifs vis-à-vis des sinistrés, mais aussi capables de remplacer, quand faire se peut, l'indemnité de chèque, enfin une indemnité monétaire, par une indemnité par la création et l'apport de services à la personne. Grâce à AXA Assistance, nous mettons ça en place un peu partout en Europe et nous estimons que nous pourrons là aussi économiser un certain nombre de dépenses que nous faisons en ce moment. Dernière chose, c'est notre politique prudente. Prudente en termes de prix, en termes de souscription, en termes de protection du portefeuille avec des hedges pour protéger les risques d'inflation sur les risques longs, en termes de cession avec AXA Cession. Depuis la création d'AXA Cession en 2002, nous avons économisé environ à peu près 300 millions d'euros dans le programme de cession de nos primes vis-à-vis des réassureurs. En fait, la première chose, c'est que tous les produits d'AXA passent à la moulinette, tous les portefeuilles d'AXA dans le monde passent à la moulinette de cette méthode, enfin du GRM, et nous continuerons, et surtout dans ces périodes, à être extrêmement prudents, attentifs et sourcilieux dans ce qui se fait dans chacun de nos pays. Une croissance additionnelle à la fois sur le marché des entreprises. Je l'ai dit qu'on avait dans notre chiffre d'affaires de la place, nous étions majoritairement un assureur du particulier, à la fois grâce au direct, et à la fois grâce aux pays émergents. C'est une croissance supplémentaire pour notre activité. Alors sur l'assurance des risques d'entreprise, vous voyez que d'abord nous avons une activité importante. En France, nous sommes clairement leaders sur le marché des risques d'entreprise. Espagne, Turquie, Suisse, nous sommes un assureur important sur ces marchés en Europe. Nous avons le bilan, nous avons le portefeuille, nous avons les clients. C'est un marché qui se développe à partir du moment où, en tout cas, sur lequel vous pouvez gagner des parts de marché à partir du moment où vous avez une distribution et des distributeurs compétents. C'est ce qu'on essaie de faire en renforçant la compétence de nos agents. En France, nous avons plus de 1000 agents qui, depuis 2 ans, suivent une formation qui leur permet quasiment de devenir des souscripteurs. C'est aussi un marché qui va s'ouvrir en termes de volume de primes, c'est-à-dire on estime que chacun, enfin c'est pas on estime, quand on regarde ce qui se passe en France, on sait que chacun des États va injecter des financements pour soutenir le développement durable dans les économies. En France, après le Grenelle, nous savons que l'État français s'est engagé sur un programme extrêmement fort d'investissement notamment sur les constructions, sur le transport, et nous estimons que, vu de notre part de marché, nous avons 250 millions d'euros de primes supplémentaires à collecter sur ces subventions qui vont soutenir l'économie française et notamment la construction de bâtiments qui vont être mis à des normes nouvelles avec les énergies solaires, et puis aussi surtout dans la reconstruction des bâtiments qui ne sont pas aux normes en ce moment. Et chez AXA Entreprise, avec AXA Construction, nous sommes, et dans les autres pays d'AXA où nous pratiquons ce genre de risque, nous sommes prêts à souscrire à ce genre de nouveaux risques. Voilà, c'est-à-dire, pour donner 2 chiffres, notre croissance P&C en 2008 et 2009, ça a été sur le marché du particulier dans AXA 0,8%, sur le marché du commercial line ça a été 1,3%, bien c'est ce 1,3% qu'on veut pousser. On a, je crois, plus intérêt à aller vers ce type de marché, nous, AXA, que d'aller vers... en tout cas compter plus sur ce type de marché pour faire de la croissance que celui des particuliers, qui est extrêmement compétitif, même si, comme je le disais tout à l'heure, les prix vont augmenter. Deuxième levier de croissance, c'est le direct. Le direct, on a une vieille histoire, une nouvelle histoire à raconter sur le direct, puisqu'une vieille histoire, puisque le direct c'était créé pour AXA en France en 1992 avec Direct Assurance, et puis le dernier lancement de Direct, c'est en Italie avec Quixa. Et vous voyez la caractéristique, si vous regardez le slide du bas, vous voyez que, à part dans un pays qui est la Pologne, parce que nous n'étions pas implantés en P&C quand on a lancé le direct, on a une activité directe sous une autre marque que celle d'AXA. C'est-à-dire ça nous permet d'aller chercher des clients que nous n'avons pas l'habitude, que nous pouvons moins attirer que d'autres par ce mode de direct, mais en même temps ça cannibalise pas nos propres réseaux de distribution quand nous faisons, parce que nous travaillons sous une autre marque. Nous sommes extrêmement sourcilieux et attentifs à ne pas perturber nos réseaux de distribution. Quand on va vers le direct, il faut faire de la pub, eh bien, nous sommes vus au travers d'autres marques. Vous voyez le taux de croissance, qui est un taux de croissance de 17%, qui est estimé à plus 17% entre 2008 et 2012. Bon, il faut savoir qu'on a 1 650 000 automobiles sur la plateforme européenne en portefeuille, et que cette année, on va faire à peu près 150 000 à 160 000 net inflows sur le portefeuille. Et que Quixa, qui a juste un an d'existence, on a déjà engrangé 50 000 nouvelles automobiles. Dernier ressort de croissance, en tout cas que je commente maintenant, ce sont les pays émergents, les pays de l'Europe de l'Est, les pays du Maghreb et les pays de l'Afrique. Vous voyez, taux de croissance, pour l'instant, ces pays nous aident à faire de la croissance. 11% ça représente en 2009 11% de notre chiffre d'affaires en P&C. Nous pensons que sur le trend actuel, sans envisager d'autre chose, à partir de cette base-là, nous sommes capables d'avoir une croissance une contribution de ces pays à hauteur de 15% de notre chiffre d'affaires. Ce ne sont pas des pays où il ne se passe rien. Cette année, sur l'ensemble de la zone, il y a à peu près un peu plus de 4,5 millions de voitures nouvelles qui ont été vendues. En étant un assureur significatif dans chacun de ces pays, bien nous avons notre part de marché dans cette production nouvelle qui est faite en automobile. Et vous voyez les taux de croissance, évidemment, c'est à partir de bases faibles, donc ils sont impressionnants, mais nous organisons pour que cette base faible, elle soit la moins faible possible et que ça contribue encore un peu plus qu'aujourd'hui à la croissance d'AXA. Voilà ce que j'ai voulu vous dire. Je voudrais terminer en vous disant que ce qu'on vous a déjà dit d'ailleurs ce matin avec Denis, c'est que notre ambition, ça continue à être la croissance, tout en maintenant évidemment un ratio combiné délibérément et d'une manière extrêmement volontariste en dessous de 100. On va faire en sorte de, comme le disait Henri ce matin aussi, de jouer un peu plus en équipe dans le P&C, c'est-à-dire de faire en sorte d'être capable de transférer d'un pays à bonne pratique ces bonnes pratiques dans tous les autres pays, donc de bénéficier de l'effet des capacités du groupe et donc d'affronter le cycle qui vient encore plus solidaire qu'aujourd'hui et avec encore plus d'énergie pour obtenir ces deux choses, une croissance supérieure aux autres, tout en maintenant un ratio combiné d'une façon extrêmement, et le gérant d'une façon extrêmement active en tout temps. Voilà, et quant à vous, vous avez la chance que j'ai terminé ma présentation.
Good afternoon, ladies and gentlemen. My name's Mark Pearson. It's my pleasure to present to you the AXA Life Japan story. Before going to Japan, I spent 14 years in Hong Kong with AXA. I was the regional CEO of the AXA Asia Life businesses, and before that I was the CEO of the Hong Kong business. So I've been in Tokyo now for about a year and a half. Very exciting opportunity for me professionally. We've got a good business there, and we think there is great opportunities to really take it to the next level. As you know, we operate in the second largest life insurance market in the world. We've got a strong positioning in our core segments, and I think we really have the potential to make AXA Life Japan even more significant for the AXA Group. And I'd like to share with you how we're going to go about doing that this afternoon. I'm joined by my colleague, Mr. Peter Etzenbach. Peter's the Deputy CEO there, CFO, and he also heads up the bank assurance operations for us as well. Right, so let me go into the presentation. Firstly, some key numbers for you. In 2008, our revenues amounted to over 4.6 billion euros. We created new business value of 299 million euros. You can see there a very healthy new business margin of over 60%. And our contribution in terms of underlying earnings was 238 million euros. We've gained the trust of a client base of 4 million policyholders, and we also have corporate partnerships with more than 1,700 corporate partners. Important to understand in Japan that our business is principally protection. Our core business is medical and life term insurance. We have a very large and nicely balanced multi-distribution platform. We operate 5 distinct channels, 5,000 salaried sales force targeting SMEs, 1,000 exclusive financial advisors targeting affluent customers, and in total about 400 wholesalers which market to large corporations, brokers, and to banks. I lead a workforce of 1,800 full-time employees in Shirokane, and as I'll show you now, I have a very good team backing and working with me that is a nice combination of good local talent and international secondees. On the top left, Yabe-san leads our sales team. He's actually been with the company more than 35 years, so he brings a lot of great local knowledge and also, very importantly, good distribution relationships. The team supporting Yabe-san, Peter, and myself is highly experienced. For that team, on average, we've worked in financial services 19 years, on average been with AXA 9 years, and on average 6 years in Japan. So it's a nice blend, I think, of good local talent, like Matsuda-san, our head of marketing, and Iwasaki-san, our head of HR, and some of AXA's strongest global leaders, most notably Mark Blottier on the IT side and Jean Soroso on the investment side. I'm very lucky, I'm very pleased with the cohesion and the team spirit of the senior team, and we are all very united in growing shareholder value. So what's the AXA Life Japan story? I think 4 key propositions. Firstly, we are operating in a good market, a market with significant potential. I'll dive into that in a minute. We start from a good space. We have a strong franchise in Japan today. We have a very clear roadmap for future profitable growth. And we're capital self-sufficient, and indeed we will start to distribute dividends to the shareholder for the first time from 2010 onwards. Okay, so let me dive into these propositions. First one being we operate in a market with significant potential. The Japan life insurance market is the second largest in the world, with over 245 billion of gross written premiums. This means many market segments in Japan are larger than the whole market of many countries. So just one example, the medical market in Japan would be larger than the whole market of the Netherlands, for example. We all know the population is aging. Now, that would be bad if we were selling baby food, but it's pretty good for our business where we're selling protection and retirement savings. And I think with an aging population with even smaller family units, the insurance needs are obviously increasing, and our customers are certainly aware of that. We've identified 4 key segments for us which are growing and have very attractive markets, even if the population overall is declining. The business environment is good. Of course, there are challenges, cultural challenges to working in Japan, but with a very loyal workforce, high education standards, and good, open, and transparent regulations, the benefits far outweigh the challenges. And we at AXA see Japan as a good business environment to grow shareholder value. Okay, so let's have a look at these growth segments I mentioned. Firstly, the singles market. As you know, many Japanese men and women are getting married less and less and later, and this means, of course, the single population is growing. Our research shows that many of these men and women are affluent and have concerns about health and nursing care as they get older. This segment itself is growing by 4% per annum, and today represents a market potential of about 13 billion euros. Secondly, the retirement opportunity. About 630 billion of funds will be in motion in Japan as baby boomers retire over the next 5 or so years. Our research shows that these retirees are not very loyal to their existing financial institution, and it is a huge market opportunity for us and the competition, and we estimate this opportunity to be worth about 58 billion euro. And thirdly, third segment which excites us is the SME segment. Like, say, Germany here in Europe, SMEs are really the backbone of the Japanese economy. And with the aging of these SME owners, business succession and retirement needs are coming to the fore. Market potential here is estimated at about 30 billion euros. So these are 3 segments we're excited about. They're huge opportunities for us, and I think also they're currently not very well served in the Japanese market. I mentioned we believe the business environment is favorable for further business development. First and foremost, the market is very open and transparent. It's also less competitive than in other countries we see. We face 44 other life insurers in Japan, which typically represents about 1/3 the number you would see in more mature European markets. Secondly, on state benefits, Japanese people will be able to rely less and less on the public health care and retirement systems, and they will increasingly need to support themselves. Today, and this is a critical thing to understand our business, the public health care plans cover 70% of medical expenses. So if you go to the doctor, the state picks up 70% of the cost of that. Looking at the public finances, I'm convinced that 70% can only go one way. Public retirement benefits today offer a replacement rate at retirement of about 39%, clearly not enough to maintain people's aspirations in retirement. These are both good statistics for us in that our core business is protection and retirement provision. You'll all know that the government in Japan changed in September, and the new party has made addressing social issues a priority. Considering the state of the public finances, this is unlikely to be possible through government-funded systems only, and we see this as an opportunity to increase the role of private insurance as well. Okay, so now let's go to the second proposition about AXA Life Japan's investment story, our franchise. We have solid positions in our core markets, and we have built privileged relationships with our customers and distributors, most notably in serving SMEs through the Chambers of Commerce and Industry. We call the CCI. I'll explain that in a while. We have a well-balanced, diversified distribution platform with both proprietary and third-party capability. Let me elaborate on this a bit more. First, in the medical market, we rank 7 in medical insurance with a 6% market share. Total premiums in this segment in 2008 amounted to about 35 billion euros. It's a large and very attractive market, very nice product margins in that market. In the VA bancassurance segment, we held a 4% share in 2008, but our share has been rising in an overall declining market. The latest data in September shows that we were ranked number 5 in this market. Peter will elaborate on this further in a short while. In the SME market, we hold an 11% market share, and we enjoy about 30% penetration within the members of the CCI. We held 20% market share of medical products sales to large corporate employees in Japan, and large corporates employ about 20% of the workforce. These are attractive positions to be, particularly in what is the second largest life market in the world. And we're very excited about having access to the 1.4 million SMEs who are part of the CCI. I've mentioned the CCI quite a few times, and somebody coming new to Japan, as I did 18 months ago, it is a very unique channel, and I'd like to just explain why and draw out some of the competitive advantages we have here. Firstly, the CCI is highly influential within Japan. It was established in 1878, prime focus obviously being to support small and mid-size enterprises. In terms of CCIs, there are 515 CCIs spread across all 47 prefectures in Japan and in all major cities. The CCI itself counts 1.4 million member companies, roughly 32% of all SMEs. And overall, SMEs in Japan employ 70% of the workforce. We have an umbrella relationship with the CCI of Japan and each of the 515 regional CCIs. And the picture you'll see here is one of our recent conferences with the chairman. It is a very, very unique distribution channel that we benefit from. I think as well the key takeaway here is it's an unparalleled platform. I certainly haven't seen it in any of the other AXA companies I know of. And also inside Japan, it is very difficult to replicate this relationship we have with the CCIs. The relationship between our company and the CCIs actually goes back more than 70 years. How it works is the regional CCIs introduce and recommend us to their member companies. We then offer those member companies tailored medical, term and protection products for themselves and for their employees. We pay them a sales commission to the regional CCIs, and these commissions cover about 1/3 of their income. And what's an interesting interaction is they are as keen as we are to increase the sales of the insurance products. So it's a very unique relationship, certainly of mutual benefit, and it gives us a great competitive edge in the marketplace. On the corporate side, we serve 8 of the 20 largest companies in Japan as measured by numbers of employees. This is also an important relationship-driven business as well, and many of these relationships have been with us over 25 years. Again, very difficult to replicate this if you're a competitor. On the bancassurance side, we have 19 partnerships, 3 of which are with the mega banks. The important takeaway here is we're focused on products that can generate shareholder value here, which means today income protection in this marketplace. And at present, we're on the top 3 of GMIB product providers in the VA space with about 20% of share here. So just finishing up on distribution, we've got a nice, I think, well-balanced distribution force that we rely on. CCI accounts for about 40% of our sales. We serve their SMEs, as I mentioned earlier, with our 5,000 strong salaried sales force. We have 1,000 financial advisors accounting for about 12% of our sales, and they serve high net worth individuals between 40 and 50 years of age. In total, 400 wholesalers marketing to corporations, brokers, and banks, which together generate about 48% of our APE. Large corporates, we market group medical contracts and, of course, variable annuities to our banks. So nice distribution mix and well balanced. Let me summarize now the third proposition for AXA Life Japan, and that's the roadmap for the future profitable growth. Firstly, and I think importantly, we are managing a highly profitable in-force portfolio of over 4 million policyholders. We've got scale in the market. Secondly, we have 4 key initiatives to focus on growth. Peter will cover these in a short while. And thirdly, we are seeing, with the dislocation in the bancassurance market, a unique opportunity for us to really create value for ourselves and for our bank partners. And last and not least, we're harvesting significant productivity gains, which we are partly reinvesting to support our organic growth. So I've covered very quickly the market potential, our franchise, and our roadmap. Let me hand over to Peter. He'll present to you our growth strategy in a little bit more detail. Peter.
Thank you, Mark. Ladies and gentlemen, it's a pleasure for me to be here with you today. We are managing a highly profitable product portfolio focused on protection. In 2008, medical sales represented 66% and term life insurance represented 28% of our new business value. Our other products, such as traditional saving products or variable annuities, account only for a small share of the value we create. Our protection products are highly profitable. Our medical NBV margin amounted to 93%, and our NBV margin on term life insurance was 55%. Every year, we are adding highly profitable business to our balance sheet. Let me please explain to you why our medical business is profitable and why we believe those margins are sustainable. First and foremost, our medical products are designed to meet our clients' needs. As Mark said, the public healthcare provides for 70% of medical expenses in Japan. Our products are designed to help our clients cover the remaining costs to them. We do not pay the balance of the 30% remaining to them. We pay a fixed cash amount per predefined medical intervention. This is a cash plan, and it's capped in total payout. We therefore do not take any risk on changes in public healthcare policy, nor are we exposed to medical expense inflation. Our product has a low capital intensity. Capital required for our medical product is driven by lapse, disability, and mortality risk, but it is not driven by asset risks. Our medical product also provides attractive diversification for the group in terms of Solvency II capital. The key value driver of our profitability is the premium margin. You see it here at 133%. Investment and surrender margins are small. The initial strain is large with 74%, but it allows us to retain a nice new business value margin of 93%. Our products meet our clients' needs. We can offer him or her sound protection while generating good and sustainable margins for us. We have spent 6 months with 70 of our managers in developing our strategy. We call it Ambition V, and you will be happy to learn that V stands for value. It stands for shareholder value. Based on very detailed plans, we are confident that we can deliver NBV growth of 15% annually over the next 3 years. The plan is built on 4 key initiatives. First, on SMEs, our initiative is to deepen client penetration. The initiative is not product-focused. Our focus is to support the sales force in the field with dedicated tax and estate advisors. We will also leverage gate openers as access to small companies. To enhance our client dialogue, we will develop advice capabilities. Second, on large corporates, we are developing worksite retirement solutions. We're leveraging our existing relationship with large corporations to provide their employees retirement advice. This is a promising initiative for us. Third, on banks, following the market crisis, the VA and bancassurance market is fundamentally reshaping. This provides a unique opportunity for us, which I will come back to in a second. And fourth, on singles, we are developing an income protection product tailored for that market segment. We will launch this product in 2010 through innovative distribution. We are leading the VA market in responding to the new market environment post-Lehman. We were the first to reduce commissions for our VA products early 2009. We were the first to relaunch a repriced product in August of this year. At today's interest rates, the NBV margin of our new product is well above 25%. We have redesigned the fund lineup. We offer index funds only. We limit the equity exposure to 20%. And as a result, we have much improved the hedge effectiveness. And we are happy to say that the new product is selling well. VA sales through banks are up 23% in 2009. And we are ranking number 5, as Mark mentioned, in the latest available data of September. In January, we will also bring our new VA product to our proprietary channels. In the bank market, we have a unique opportunity. It is unique because we really see market dislocation. And this market dislocation provides us an opportunity to fundamentally reshape our positioning in the market. Where do we see the opportunities? Japanese retail investors hold 50% of their assets in cash. Japanese retail investors will have to prepare for the income needs of their retirement. We believe that our GMIB product is well positioned to address that need. We are capitalizing on the exit of competitors representing 18% of the market. We know where Hartford and ING were selling, and we are targeting those accounts. We will broaden our product lineup. In particular, we will launch medical products through banks. This will allow us to deepen our relationship with them and to make it less dependent on one product only. We're also expanding our distribution footprint. We are happy to be launching 1 new mega bank, 1 securities house, and 2 regional banks over the next 4 months. We're excited by the opportunity in the banks market. We want to grow our shareholder value and not only volumes. Our strategy is therefore to harvest productivity gains, reinvesting some of the savings we make to support our organic growth. In January, we launched a Salesforce productivity initiative. The project is quite simple. It is a back to basics. First, we focus the Salesforce on how to maximize the time in front of the client and how to best use available tools. Second, we are adjusting the compensation structure to best align it with our objectives of creating and retaining value. We have discovered that even in Japan, compensation drives behavior, and we want to drive it in the right direction. The initiative sounds simple, and it is simple, but the outcome of the pilots which we launched in April are very promising. We are confident that this initiative will allow us to generate 8% in additional NBV through these proprietary channels. In January, we also launched a cost reduction program. We have reduced head office staff by 8%. We have merged the 2 life companies we had in Japan, and we have cut operating expenses. Over a 2-year period, 2009 and 2010, we will generate 70 million euros of annual savings, representing 20% of our non-commission expense base. We will reinvest part of these savings in order to grow our franchise. We will strengthen our brand and substantially increase our advertising budget. We will invest in our IT infrastructure to optimize our core processes going forward. Our strategy is ambitious, but we have the means to achieve it. Coming to Japan, we were impressed by our customer service capabilities. Our claims handling processes run at a 5 Sigma quality basis. We have substantially increased our customer satisfaction scores. We also have a terrific risk management and sound ALM strategy. We were one of the first long investors to spot the opportunity of negative basis trades. The risk-adjusted returns on those are quite compelling, particularly when we started making those investments in January. Unlike some of our competitors, we take no currency risk and we take no foreign interest rate risk on our balance sheet. We feel good about our ALM and we feel good about our asset base. We have taken many steps in 2009 to enhance our return on capital. We led the market in improving VA margins. We focused product mix on protection business with high margins. Our medical products have, as I mentioned, low capital intensity and therefore generate returns well in excess of 15%. And we have linked our channel compensation to value and are more generally aligning distributor compensation. We are confident that we have the means to achieve our strategy. Where do we see the challenges and how will we address them? We receive many questions around the new Japanese solvency regulation, which will take effect in March 2012. We are comfortable with the new framework. It is risk-based. We see the coverage ratios in the markets going down by half, but we do not believe at this stage that market players will attempt to go back to the former coverage ratios. More importantly, proper risk-based solvency will discourage some of the irrational behavior we have seen in Japan in the past. We receive even more questions as to how we manage in the low interest rate environment. Well, we sleep well, and why? First, as presented, our core medical product is not very sensitive to changes in interest rates. Second, we have just reduced the guaranteed rate on our group pension business by 50 basis points. Our group pensions are simple general account savings products. Our decision resulted in cash outflows of around 1 billion euros in 2009, which represent less than 3% of our invested assets. Net of the cash outflows, the rate reduction is positive for our earnings and returns. We note also that Daido, our biggest competitor in the space, is following us and will reduce their rates in April. Third, we have actively managed our legacy in-force down by 50% over the past 6 years. This was part of the strategy presented to you in 2004. Finally, we have adapted our investment assumptions on those legacy in-force businesses, reflecting the current environment in our current ALM strategy. This will generate in 2009 a one-time impact on our underlying earnings. Let me please hand back to Mark, who will outline our financial objectives and summarize the presentation. Thank you.
Thanks very much, Peter. In line with our ambitious strategy, we've set ourselves some ambitious financial goals. We've committed to grow new business value by 15% per annum until 2012. And as the CEO, I'm confident that we can do that based on the growth initiatives we've just outlined. Of course, we are focused on earnings. We will deliver earnings growth because our protection business is very profitable. We are generating significant productivity gains, and because we are successfully managing our large in-force book. So as the CEO, I've set a target of 8 to 10% annual growth of earnings over the medium term. As we mentioned earlier, we are capital self-sufficient, and we will start to pay dividend in 2010. And we've set ourselves a payout ratio of 50% thereafter. So please hold me and my team accountable for that. And just finally, just some final comments, and we'll break for questions. As I mentioned earlier, I'm very excited to be in Japan. It's an exciting opportunity for me and for AXA. We have a great business there, which I'm looking to take to the next level. It's a market with significant potential. We have a very strong franchise in AXA, a good roadmap for the future, and we will start distributing dividends in 2012. So one good question will be, I'll just come to you in a sec. One obvious question will be, what's changed since the last time we presented in 2004? Well, I think as Peter covered, there's been some significant changes in Japan, which I think play to AXA's strengths. Firstly, in the bancassurance market, there's been significant dislocation, and we have seen many competitors exit the marketplace. There's a vacuum now, and it's a much more rational market, and this is a good opportunity for AXA. The upcoming changes in capital, again, we think will lead to a much more rational marketplace in Japan, and one where AXA's strengths will be well suited. We have certainly, over the last couple of years, increased the agility of the company. And as I mentioned earlier, we have reinforced, and I'm very confident with the strength of the senior management team. So myself, Peter, and our team are very committed to creating good long-term value for our shareholders. Thank you very much for your attention this afternoon. And why don't we open up for some questions? And the gentleman at the back should be first. He had his hand up a long time ago.
For those of you who are still alive and awake, we are ready to take questions. Who wants to start? No questions. Okay, the meeting is over. Okay.
Yeah, Tony Silverman, Standard & Poor's Equity Research. Just a very general question. I noticed in the earlier presentation this morning on risk that the KPIs are basically use IFRS, or perhaps it's slightly regulatory reporting for the AFR. Is this a further downgrade of the embedded value reporting? And where would it feature in the KPIs?
Why would you think that?
Well, the new KPIs that you outlined in that presentation, didn't involve embedded value reporting.
Yeah, but don't throw the baby with the bath. I mean, the fact that we have some new ones doesn't mean that we do not take care or do not pay attention to embedded value.
No, but more precisely, you saw two KPIs on this page: net income divided by short-term economic capital, and variation of IFR divided by short-term economic capital. Because the short-term economic capital is based on an economic balance sheet, it's very much for a life business a proxy for return on embedded value, and the equivalent of a return on embedded value for P&C. So it's really not something that is inconsistent with that, except that we have, because in the Solvency II framework, we've extended essentially the economic balance sheet from life into P&C. That's all we did. Okay?
Thank you.
Are you reassured?
Yes, if that's the word. Thank you very much.
Okay, whoever. Yep.
Hi, Farouk Hani from Morgan Stanley. You've talked a lot today about, with some exceptions, about how you defend your business against volatility, against risk, how you rebuild economic profitability in non-life, how you address a kind of almost still a defensive posture. Apart from acquisitions, where are we going to get real underlying earnings growth?
I do not think it's a defensive posture at all. I think the crisis has shown, as I said this morning, the resilience of the model. We thought we were owing you some answers on the way we would develop further the business in a profitable way, avoiding the tail risks which we have seen over the last 15 months. And we hope that, at the end of this session, we will have convinced you. I think none of the fundamentals in terms of market potential growth has changed. On the contrary, I think the need for savings in developed as well as in emerging countries is bigger than what it used to be. Remember what Peter Krause was saying earlier today on the fact that many pension funds are now underfunded. This is going to mean additional contributions from the corporations. The individuals will have to rebuild their savings. We are emerging from this turmoil as a reinforced brand, because I do not think, more than that, I think that the people who will have to invest their assets will have a tendency to prefer the corporations which have managed their own business well, rather than the ones who had to go and ask for government support to manage their own balance sheet. So I think the reinforcement of the brand is not something you should underestimate. So the market in general is a market where the business lines should grow once we will be out of the recession for the P&C business, and even before that for the savings business. Look in the US, the savings rate is starting to come up in the very preliminary phases because people are scared. They go to non-risky investments. Once they realize that the returns on non-risky investments is zero, they start to have more appetite for more risk. This is going to play in our favor. And basically the proposition we are putting on the table, which is investment with guarantees, properly priced for both the client and the manufacturer, is, I think, in the long run, a winning proposition. So if you combine that with the fact that we want to increase the exposure to the emerging markets, I think there is very decent room for underlying earnings growth. What would you add?
I think the brand point should not be underestimated. So we come out of this crisis with the #1 insurance brands. We have chosen to present to you the businesses on which you had doubts. So you are in all the roadshows that we have made in the last 18 months, you were challenging us on our position in the UK, in the US,
in Japan,
in Japan, and you had started to challenge us since the beginning of the year on P&C underwriting cycle in Europe. So we have decided to address those very issues, but our brand is stronger. We believe that we have made earlier than others the adjustment to risk management that were required on the back of this crisis, and we believe that we have all the ingredients for success now.
And I mean, if you want to have an illustration of that, it's clear to us that in the discussions we have to expand the distribution with sophisticated partners, bancassurance agreements, we are facing less competition than 2 years ago because some of the competitors have disappeared and because we are a stronger name. And we think we will see more of that.
Yes, Jean-Hervé Becourt-Chevreux. You highlighted at the introduction that the legal structure of management is going to change, and supervisory board and board of director. Does it change anything for you? Does it change any change of managers, and does it mean a new inflection in the strategy? Thank you.
Well, the change in governance, moving from a 2-tier to a 1-tier board, first it's at the suggestion of the board and at the suggestion of the chairman of the supervisory board. So it's not something I was desperately asking for. I think it makes sense because it's going to simplify, to, I would say, raise the level of accountability from everybody. I mean, from the management and from the directors. So I think it's a good move at the right time. I've lived under many different structures. One of the lessons is what is very important is not I would say the design of the structure itself, it's its reactiveness. It's true that it's going to help us be more reactive, have the directors probably more involved. So I think it's a good thing. Is this going to lead to some managerial changes? Well, I mean, for those of us who know us since the beginning, they know that we have been constantly adapting the managerial structure. So this is not going to stop us adapting the managerial structure. I mean, it's a living organization where you have people who are coming, working, moving to other interests, people who are joining, people which we are developing and at one stage or the other become operating CEOs. So you should expect on a permanent basis to see in this company some managerial adjustments. We need to, I would say, develop the businesses, develop the individuals, prepare successions, and it's an element to which we all dedicate a significant amount of time. So you should not be surprised. Yep. Well, Andrew? Or, yeah.
David Collins, Oxif. A question on non-life insurance. From my experience following financial companies, we only see expanding margins following periods of poor profitability, balance sheet distress. The banking sector is the perfect example at the moment. A lot of insurance companies in Europe are talking about raising prices and so on, but we've not seen real financial distress, maybe a little bit in Italy, but not in the other regions of Europe. Do you think that we can see expanding margins following the price increases that insurers are putting through, or are we more likely to see profit warnings and that sort of thing before we see margin expansion in non-life insurance?
Well, I think the first thing you have to have in mind is I think one of the reasons for which the insurance sector has resisted better than the banking in this crisis is that the insurance sector had its own crisis between 2001 and 2003, which made I would say, which made the industry more reactive. And everywhere, combined ratios have improved. Now they are deteriorating because of the recession, but everywhere the combined ratios have improved. And I think nearly everywhere, probably not everywhere, but nearly everywhere, the companies have understood that financial income would not be going forward what it used to be in the 80s or even in the 90s. Because of the change in the structural asset allocation and because of the fact that the markets were not as buoyant as what they used to be. So that's why I think the cycles are going to be shorter than before, and that's why I think you will see very quickly some changes in the pricing. Is it going to happen at the same time everywhere? Not. Is it going to be as easy in all the markets? No. It's clear that there are markets where it's coming later than others. But if you look at the French market, we are quite confident that it's going to be a pretty reasonable situation. And look at what has changed since the spring. I mean, in the spring, many players were saying that they were intending to lower rates further. Nobody's saying that anymore in the French market. If you look at some other markets, things have started to change. It's still difficult in Germany. It's still difficult in the SME market in the UK. But we have reasonable reasons to think that it's probably going to come quite soon. What would you add?
It may take 2010 and 2011 at the level of the market and not be realized totally in 2010. If we look at the situation across Europe, the markets that have improved substantially have started with Ireland. The UK is following, but less fast than people might have thought. So I think we will have a period of, I would say, gradual improvement starting in 2010. That's our expectation.
But it's, I definitely think it's going to be less cyclical than before, because the pressure on the players is going to be higher than before. And don't forget, I mean, even if many of them have not been bailed out by the states because the sector didn't need it and had sufficient capital, the fact that it had sufficient capital doesn't mean that it has a lot of excess capital to burn just in a sort of stupid price war.
Hello, Andrew Queen at Autonomous Research. A couple of questions. As you try and put more growth into the overall portfolio, acquiring businesses in emerging markets, will you finance that more by selling businesses in mature markets or just using equity? And secondly, although your balance sheet has survived 2 crises in the last 10 years, your share price survived neither of them. It collapsed on both occasions. How do you think about that? Because we'll obviously have another crisis. How do you think about what you can do to try and get the share price to remain blissfully flat while the markets fall?
Great question, Andrew. I have the answer, but I want to share it only with a limited number of people, so we are going to do it off record. No, on your first question, as you've seen, I mean, we are quite pragmatic. There are no sacred cows in this group. I mean, we've sold the non-core businesses now years ago, and I think we were right to sell them. I mean, from DLJ to reinsurance. But we've also sold underperforming, when compared to the group average, insurance assets like the Netherlands, like Austria. And if the Australian deal succeeds, we think it makes sense to have our Australian operation combined with AMP because they have synergies we don't have, and the proceeds will help finance the expansion in Asia. So we are very pragmatic. Nicolas has told us today the way he's going to send some capital back to Denis as quickly as possible. So it's a way to show you that what we are trying to do is to efficiently use our capital. Does this mean that we are never going to raise capital to finance expansion? Of course not. But we would say we do not want to have underperforming businesses with no middle-term hopes in the portfolio. We resist to the temptation to sell businesses at the bottom. I mean, if we had followed some advices, I would say since I took over in 2000, if I had followed many times quote sort of Main Street advice. We would have sold P&C in 2001, on 2001. We would have bought a significant exposure at any price in life in 2006, 2007, and so on and so forth. We would have raised capital at the bottom of the market. Twice, okay? So we listen very carefully, and then we do what we think makes sense. Okay, so that's the answer. I mean, we will be pragmatic, but I think the way we do it is we think that our duty as a management team is to manage the capital tightly. We do not want to have huge buffers because we think they have a cost, which is paid at the end of the day by the shareholders. But on the other hand, we do not want to be in a position where we have to raise capital at times where the shareholders would find it unpleasant. That's why, I mean, the only way to get out of this false dilemma is to have superior risk management tools, what we have, okay? Because this allows us to operate with a comfortable level of capital, but with no excess comfort. And we are fine with it, and we have now resisted 2 very serious crises. And it's going to be the same thing for the third one if a third one happens. What is the share price going to do at the time? I don't know. You will tell me. But what we think is that the people who have been burnt by selling, following the recommendations of the people who were very negative and thinking that we would not resist, will be more careful next time. I think, I mean, we are investing as much as we can to improve the quality of the risk management. We are very comfortable. If you look at the average or at the cumulated experience of the management team in the sector, it's now a very decent one. There is something I'd like to insist on. We are not that old. Also, we are aging every day. But we start to have in the sector a significant tenure, whereas in many other companies, management have turned around at a much faster pace. So we think it doesn't mean we know everything, because we know our weaknesses. But at least we know where are the critical areas and where we have to be careful. And I think that, well, seeing that we have resisted twice, some people will probably conclude that this was not a sort of pure coincidence. Maybe there was something.
So one question, obviously, is the amount of disclosure that we give, because we believe that we give more disclosure than any company in the sector. And at the end of the day, you still ask for more. And at the end of the day, as you pointed out, it doesn't help. So I don't know if we should go for even more disclosure, or if we should go for less disclosure, because giving you more disclosure has not helped in the last turmoil. I believe we are very transparent. We give you all the tools that you require to make your own determination, but still we had to go through a difficult path this year. I believe that, as I pointed out in my presentation, we are conscious that we have probably a little, I mean, that's the weight of financial risk on our balance sheet because of our mix of business is slightly higher than what we would like to have. So we will work on that going forward. But there is no mystery here. If our life business represents 70% or 80% of our reserves, it's difficult to not to have a substantial portion of financial risk in our balance sheet. So that's a partial answer to your question, but we are very conscious of this situation.
Thanks. It's Paul Goodhine from Redburn Partners. Could I come back to the non-life insurance business? You're talking about this mainly in terms of the cycle, and I wonder if there's not an underlying issue there, because you're showing on one of the slides of the European P&C presentation a 98 combined versus 95 for the peers. And the explanation is that your tail is longer, given your mix of business. That explains that difference. You're looking at, I think, calendar year combined ratios there. If you adjust for prior year, you have a much higher level of releases than your competitors. That probably moves the gap to 6 points rather than 3. And that 6-point gap is not, I don't think, covered by your different mix of business, implying that you're, on your economic combined ratio basis, actually a bit worse than your peers. So you don't seem to be translating, at least at the moment, your scale that you clearly have in your markets into superior performance for shareholders. Is there an issue there, and how would you think about that point?
Okay, I have a hard time comparing our economic combined ratio, which is a measure that is, I would say, specific to the way we look at our business, with economic combined ratios of our peers. What I can tell you is that over the cycle, our return on equity on P&C is higher than 20%. So I have no, I mean, I know that there are a few players in Europe that have a better profitability on their P&C portfolio than AXA. I would think of Mapfre as an example, and maybe Coburg in Germany. But all in all, compared to our large international peers, I don't think we have anything to, I mean, we have anything against us in terms of profitability and return on equity on our P&C portfolio.
I'd ask sorry, I would add something. Yes, we have a slightly higher combined ratio, not only due to the fact that the business mix is slightly different, but also to the fact that the reserving is more conservative. And if you look at the reserving level, it's higher than most of the competitors, as it was shown in François' presentation, and it has remained stable over the years. So in other terms, if you had the suspicion that we were trying to milk the reserves just to I would say make the short-term earnings look better, this is proven wrong by the long-term track record of the P&C reserving. We are more reserved than many others, and we've been consistently showing bonies on previous years, which is a confirmation of the fact that the reserving is more conservative. Blair.
Thanks. It's Blair Stewart here from BofA Merrill Lynch. Just coming back to one of the very first slides in your introduction, Henri, you talked about expanding distribution. It's probably been in every strategic presentation you've given for the last few years. So could you perhaps give it a bit more of a modern feel by telling us where the opportunities are at this time, do you think, given we're just emerging from a major downturn? And related to that, your move into emerging markets, I mean, is that driven by what you perceive as a strategic weakness? Is it driven by the availability of assets at the moment, or is it driven by exceptional value for money?
Thank you. I mean, these are, I would say, two slightly different questions. On distribution, I think the model we've chosen, which is to be multi-distribution. I mean, remember a few years ago when we were just starting to discuss it with you, what we were saying was that we were open architecture, multi-distribution. I think this has proven to be the right choice. We want to stay in the, quote, multi-distribution business, meaning we want to have a proprietary sales force and a growing one, because a proprietary sales force is more disciplined and more resilient in difficult times. The price you have to pay for that is that it's, generally speaking, a more expensive form of distribution. So there you have to try to, let's say, reduce the turnover and improve the productivity of the average salesperson. We want to continue to do that. One of the things we've done over the last years is to attract experienced salespeople from other companies. We are still continuing to do that, and it's working. So, and if we can acquire proprietary distribution, we will do it. Then you have the non-proprietary distribution. And there, one of the space which is probably going to be more open in the years to come is, as I said this morning, the bank assurance. Not that we want to buy banks, but we think that banks are going to, I would say, question their capital allocation. And I would say some of them had bought insurance companies which were independent from their networks. Most of them have sold them since. Some of them had built internal insurance operations through subsidiaries. The way MPS did it. And we think we will see more opportunities like the one we've had with MPS, which is banks questioning the validity of putting themselves 100% of the capital in subsidiaries which are manufacturing insurance products and which on a global basis are going to be subscale if they do not join forces with players for whom it's the core business. So on the bancassurance field, maybe not in 3 weeks, but over time, we'll think we'll have more opportunities, ranging from distribution agreements to co-ownership of the factory. Then, as François has explained to you, we want to accelerate on the direct side, because we think this is going to be a growing proposition, and we think that the strengths of the brand in many cases can be useful there. In the places where our proprietary distribution is not too strong, and where the channel conflict is therefore easier to solve. So that's, I would say, for the distribution. And there, the strength of the brand is something really important. On your question on emerging markets, the reason for which we want to accelerate there is simple. We, despite the fact that many companies within the group are, quote, old companies, the group is itself, at its size, is younger than many others, which explains the fact that we probably have been late when compared to the early movers in addressing the emerging markets. Because what we had to do was to consolidate the acquisitions and to make sure that the group, at the scale it had reached, would survive and prosper. What we basically have done between 2000 and 2005. And since 2005, because we were pretty sure of our backyard and pretty comfortable with our backyard, we have started to accelerate in emerging countries. And you've seen that even just before the crisis, we had made some significant steps, like Mexico, like Russia. Basically, what we are saying now is, well, it's back to normal. We want to continue to increase the exposure in these markets, knowing that it's not that easy and that obvious, for a couple of reasons. I mean, the first one is that it's not generating cash very quickly, especially if you develop life businesses. Second point, many times you are diluted by minority, if not majority interests. There are a number of emerging countries, starting by the very large ones, who are protecting their financial sector much more than other sectors, not letting non-locals have full access to the market. If you look at China, it's a very perfect example. First, you are limited in your ownership. Second, you are limited in your geographical reach. So it's not something which is going to be a magic bullet overnight. But we want to expand there. And we think that there are emerging markets which are not necessarily the obvious ones where we can do a good job. If you look at what we've done in Turkey and what we could do in the adjacent former Soviet republics, it's an interesting example. When we look at what we've been doing in Mexico, I think it's another interesting example. I hope we will have some opportunities in Latin America. How are we going to find them? Well, probably some players will have to sell their stakes. We hope that some banks will look for manufacturing partners through distribution agreements or joint ventures, and we'll see. And we are ready in some specific cases to start with greenfields.
On distribution, Blair, you asked what has changed in the last 5 years. I believe that we have talked about expanding in bancassurance distribution for quite some time. We now have credentials. Compared to 5 years ago, we have very successful bancassurance JVs. The Montepaschi bancassurance JV is a success. The Mandiri bancassurance JV in Indonesia is a success. So we have credibility in bank distribution. On the proprietary distribution side, we've expanded our proprietary networks in emerging markets quite substantially. We have added something like 40 or 50,000 agents. So we're continuing to build in emerging markets. And in developed markets, as Henri was saying, we are not adding much in terms of net numbers in proprietary distribution, but we are adding to we are improving the productivity by hiring skilled people and increasing the average productivity. So I believe that we have reasonably good credentials that we've built over the years, and that are a good basis to keep going there. Nick.
Nick Holmes at Nomura. Solvency II. Wanted to ask, what your thoughts are here. The latest EOPS proposals really seem to be the main threat, not just to you, but to the whole sector. And I wanted really to ask two questions. One, how did we get to this point, sort of whose eye was off the ball? I mean, that this is sectoral, not specific to you. And then secondly, what is your level of confidence that the proposals as they stand will be amended in a way that doesn't need us to be worried?
Yeah, I mean, we'll share the answer, but like in any good theater play, you have 4 acts. The first one is setting the scene. The second one is tension going. The third one is devastation. And the fourth one is happy end. So, is it true or not? So it's a theater play, okay? We are between Act 2 and Act 3. If you look at the various characters, the Commission has temporarily exited the scene, okay? And the new Commission is probably going to enter the scene at the beginning of Act 4. But not yet, okay, or at the end of Act 3. The bad guys, I would say the father in the stories where the young lady cannot marry the young guy, the chaos is alone, is alone on the scene. So they can do, and the Parliament is in the back scene, not knowing exactly at this stage what to do. So the CAOPS is asking for all what they've dreamt about with absolutely no constraints and losing sight from what the Act 1 was, which was setting the scene. So at the end of the day, reason will prevail. The industry is in its role, crying like the pig you are trying to slaughter, and rightly so, because if you don't cry, nobody is going to cry for you, okay? So I think at the end of the day, reason will prevail for a very simple reason. And Denis will come to the specifics, but I'm not joking there. People underestimate to what extent there is going to be in the new world capital scarcity. And we need some education on that. Okay? Everybody has the feeling that reforming, first, that you need to reform everything in financial services, where the crisis was mainly a banking crisis. Second point, everybody has the feeling that capital is for free. Time will progressively tell that it's not necessary to inject capital everywhere and that capital is expensive. When reason will prevail, I think everybody will realize that, okay, maybe there are certain areas of the banking sector where you need more capital, but why would you put more capital in the insurance industry, which has resisted the one in a 200-year storm? I mean, is it from a political standpoint a priority? Because if you increase significantly the amount of capital required, the markets are not going to change. They are going to want to have returns on this capital. It's just going to make coverage less available and prices more expensive. Is this really what you want? If what you want is to have decent and sustainable growth in both the US and Europe, I don't think. So I think progressively we are, I would say, in a sort of education mode. It's up to the industry to explain that insurance is different from banking. And we are doing our job there. I hope not too bad. But I think over time, reason will prevail.
So it won't be a Greek tragedy?
Hopefully not.
So after Henri's description, I'm not sure you want the technical answer. But in case you do, we are in regulation of financial services, which means that the Lamfalussy procedure is applied, which means that you have a level 1 directive adopted by the Parliament. And this level 1 directive is a good basis. I mean, there has been some comments against the level 1 directive before it was adopted in April, but we believe that the level 1 directive, which was adopted in April 2009 by the Commission, the Council and the European Parliament, is a good basis. We move now to the level 2 directive. For the level 2 directive, the European Commission has the pen. The process which is described as the Lamfalussy procedure is that the College of Supervisors, the CEOPS, gives advice to the Commission. It gives advice in 2 steps, and for 2/3 of the papers, the advice has been given in the 2-step by CEOPS. So we know how bad it is. It was very, very bad in the first step. It's still very bad in the second step. Now the Commission has the pen, and the Commission will take its time, which means that they will form a preliminary view sometime in the spring. They will give the industry instructions for QAS 5, which is supposedly the last attempt to calibrate in real terms the capital requirements and determine the available financial resources that are put across these capital requirements. We'll go through QIS 5 in the fall of 2010. CEOPS and the Commission and the industry will analyze the results of QIS 5, and at the latest in the second half or the last quarter of 2011, we'll have the final rules. In the Level 1 directive, it was clearly indicated that what was wrong was not the level of capital in the industry. So we'll go back to that. As a fallback, we have the European Parliament. And we know that the European Parliament will make sure that the Level 2 directives are in sync with the Level 1 directive. So if there is any contradiction, if the result of the Level 2 directive is that more capital is required, the Parliament might ask the Commission to go back to the drawing board. So we believe that we are in a reasonable place and we are still in a period of dialogue.
Thank you very much.
Yeah, Thomas.
Thomas Jacquet, Exane. I have a question on the geographical footprint of the group, which is expanding a lot. You are now talking about Latin America. You added Russia, and probably you are going to expand also in Eastern Europe. How do you make sure that the group is not becoming too big to manage? And how do you make sure that Denis still knows all the numbers in all the countries?
By building management. I mean, the key, I would say the key element we are looking at when we are looking at expansion opportunities is not very much the financials, because they are the easy part to deal with. It's, do we have the management, and did we build a strong enough management to support the expansion? And it's, I mean, last year or the year before, we did a presentation to you, explaining you what the HR policies were. We are still building on that, and I think the strengths and the depths of the management is continuously improving. I would say if I look, and we would not, and to be very precise, we would not invest in a country if we think we do not have the appropriate management to do it. But having recruited and having developed now a significant number of talents and knowing them much better than a few years ago, I think we are in a better position. And if you compare I would say the size and the scope of the group with many others, we are still more compact. The last point I would make, it's one of the reasons for which we have built regional structures. Because we think that if we want to stay on top of things, it's not by having 57 or I mean around 60 operations reporting directly to the group. We use the regional level as a way to be closer to the operations, share some resources, increase the efficiency and the transparency. And by the way, I think the saturation capacity of Denis about knowing the numbers is probably a sort of three-digit number of countries.
Here I have to disagree with Henri. I think that beyond management, what we have done across the, over the last several years, is to build standards. We've built a common language and a common discipline within the group that I would say will resist beyond management successions. And so I am completely unimportant there, because now we've built very strong standards, including a very strong risk management standard, which applies across the board. 10 years ago, our only source of information was the consolidation, basically, I mean, to make it a little bit caricatural. Now we have lots of data points, lots of information that are coming to management and that are making sure that there is constant discipline applied at the local level as well as at the global level. So we have put a combination of strong management, but also strong operating principles and standards.
Marcus Rivaldi, Morgan Stanley. Just a quick question again on the non-life side of things. I mean, have we got things a bit wrong? I mean, are we getting a bit over-concerned about the state of play in the non-life market? I mean, using your traffic light system on the risk management, are you at green or amber or red light with regards to concern about non-life business and where it's going over the next 12 months?
It's certainly not red. If we've told you that we had taken action starting, I would say, earlier this year, it's that it was amber, because we didn't want to have it slip. What we hope is that it's progressively going to go back to green over the next 6 to 18 months. But I think there is no reason to think it's going to go to red.
And as we've indicated, the fact that 50% of our P&C footprint is through proprietary distribution gives us the confidence that we will be able to implement the changes that we've said we would implement. Now, I think we are 10 minutes over time. So before ending this presentation, we have time for one last question, if any. If not, we'll adjourn.
I'm surprised we have no question on the very reasonable and very compelling offer we are making to our friends down under.
Good.
Okay. You never know, Blair. Okay. Thank you very much.
Thank you.